Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. Our program will begin now.
Over the next 3 years, global wealth should reach $629 trillion. Is that under threat? The risks are increasing, driving both competition and creativity. With a world in disorder, we look at new strategies to create and preserve wealth and ask, can prosperity and instability coexist? This is Bloomberg Wealth.
I am Nuno Matos, HSBC CEO of Wealth and Personal Banking. Wealth is transforming in the way it's created, managed, and invested. We serve over 40 million customers, covering the entire wealth spectrum. We have a responsibility to not only adapt to this change, but to lead it. Today, uncertainty prevails. Events such as Bloomberg Wealth are crucial for fostering new ideas and discovering opportunities that arise from this uncertainty. I wish you all a fruitful Bloomberg Wealth 2024.
Please welcome to the stage our host, Bloomberg's Eric Schatzker.
Hello, everyone, and good morning. As you just heard, my name is Eric Schatzker. I'm the editorial director of Bloomberg New Economy here from New York. It is my great pleasure to welcome you all to Bloomberg Wealth. Whether you're joining us virtually from around the globe or you're here in Hong Kong with us in person, we're delighted to have you taking part. Thank you all for coming. Today, as you might imagine, we will be talking about the issues most critical to wealth management and to investment decisions here in Asia and, of course, far beyond. Geopolitics, the macroeconomic trajectory, demographics, and more. Plus, we'll be exploring what's next for Hong Kong as a financial center and who among its emerging rivals poses the greatest challenge. And with those stunning results in from the India election, we'll be exploring what they mean for investors. That is all coming straight ahead. First, however, folks, I'd like to take a moment to acknowledge our founding sponsor, HSBC. Now, time is always in short supply for our first speaker of the day, so let's proceed without delay. Eddie Yu is Chief Executive of the Hong Kong Monetary Authority and one of the world's most respected central bankers. Please welcome him to the stage, along with my colleague, Bloomberg's David Inglis.
Thank you. Good morning. I wanted to start out on a bright note. My colleague Eric mentioned the stunning results in India. And so I was just off the phone with my producer, so we're broadcasting live in a couple of minutes here. And they gave this stunning statistic yesterday. There was a massive sell-off in markets in India yesterday. $400 billion was the amount that was wiped off the value of Indian equities yesterday. Single worst day for Indian equity markets on record yesterday. So on a positive note, Eddie, how are you?
I'm good. I'm dealing with all the uncertainties in the world that you talk about every day.
So we're at the Wealth Summit, and one of the things that I constantly grapple with is how Hong Kong as a city measures its progress as a wealth hub, and what the HKMA's role is in ensuring that you are on path for those objectives.
Right. Well, as you know, Hong Kong has been the largest asset and wealth management center in Asia for a number of years. And we are continuing to improve our platform through a number of initiatives that we do in collaboration with other regulators and also with the government. Let me just give you a very, very broad survey of what we've done just in the past year. There are three areas that we've pushed out new initiatives. One is the new schemes introduced by the government. One is on single-family office, a tax concession scheme. So if any single-family office comes into Hong Kong investing $30 million US dollars, and they will be entitled to the tax concession. The second one, and I was told by many private banks here that the response from the clients has been very enthusiastic. So I'm glad to see that. And if there should be any further refinements to the regime, do let us know, and we are very happy to take it up. The second scheme is called the Capital Investment Entrance Scheme. That was just introduced in March. So for any individual investing about $4 million US dollars into qualified assets in Hong Kong, they can get a Hong Kong passport. And I was told, again, by the government that in just 2 months, they've already got 50 applications. So the response has been quick and quite positive. And this actually brings in new sources of capital into the wealth scene of Hong Kong. The second area is to increase the connectivity of the wealth products in Hong Kong with the mainland. And you're aware of the Wealth Management Connect 1.0 that was introduced about 18 months ago. It was a very cautious start with restrictions on quota, on products, or even on selling process. But it was a smooth start. That's how you do relaxation in China. You have an orderly, smooth start, and then you try to widen it. And we did the widening at the end of February with Wealth Management Connect 2.0 by increasing the individual quota, relaxing the eligibility criteria, especially for the southbound flows, capital coming from the mainland individuals to Hong Kong, expanding the suite of product from just bonds into equities, and make it easier for the marketing and selling process. And the numbers that we see in March and April coming to May is actually a very significant increase. in the southbound flows, both in terms of the number of new accounts and in the remittances that were made. And of course, we will not stop there. We are already looking into whether there could be possibilities of Wealth Connect 3.0, and if so, what could be in it. And we are talking to the industry very closely about what's needed. Is it a quota, or is it the scope of products, or is it the selling process? So the connectivity has been increased very significantly through the Wealth Connect 2.0. And just very briefly on the third area is on our own regulatory arrangements. There's always a balance between regulation, especially investor protection, and the ease of business for our wealth managers. And taking account of the feedback from the industry, in July last year, we, together with the Securities and Futures Commission, introduced a new circular, basically making it easier in terms of certain requirements in suitability and disclosure for the wealth managers to deal with what we call the sophisticated professional investors. So that means the wealth clients with a certain asset amount and with certain experience, they can actually waive some of the suitability and disclosure requirements. So, and all these three tracks, new schemes, new capital, connectivity, and regulatory refinements, are actually an ongoing process. And we welcome continuous discussion with the industry so that you can actually tell us what we should do to even further enhance our wealth management center in Hong Kong.
Right, and I think Amy and Annabel are here, of course, to talk a little bit more about what they want to hear, hear from Eddie. Wealth Management 3.0, do you have a rough timetable of when you want to get that in place? And also, based on the feedback that you're hearing from market participants, what's a sense of what they want?
Well, I think it's still early days. We've just introduced Wealth Connect 2.0. But whether, well, I think Amy and Annabel will tell you more what they want. But there are things like, for example, the quota.
Okay.
Currently, individual quota is up to 3 million RMB, but that's actually not quite enough for private bank clients. Is there a way to have a separate channel to capture the private bank clients? The selling process, it's been a lot easier and smoother than before. But can it be further streamlined, or can the marketing be made a bit more active? Can the education be done better? So I think there are still areas that we can look into in terms of improvements.
Okay, yeah, and you bring 3 million Hong Kong dollars. That's tiny, Eddie.
3 million RMB.
RMB,
Yeah,
that's still tiny.
Here you're talking about mid-wealth, which actually has the biggest need for diversification on the mainland.
Right. Okay.
Because for the ultra high net worth, they've got their ways of investing globally. But for the mid-wealth, for the middle class, they need to diversify. Most of their assets, personal assets, are actually either in the housing sector or in Chinese equities. And they have a very big need for diversification. And I think Wealth Connect actually provides them with this easy, convenient, and ready access.
So the affluent, the poor of the group, as they say. Now, there's been certainly conversations on our shows a lot, and we have a lot of asset allocators here. An increasingly bigger allocation of people's wealth are going into alternatives outside the public markets, into private markets, real estate infrastructure, private equity, private credit. As a regulator looking at that, that's an area of the market that is less liquid, it's less transparent. Are you concerned over the risks? How are you looking at that from a financial stability perspective?
Right. As you know, we ourselves as an investor has been going into private markets for 15 years already. So we kind of know the market. And you're right in terms of the risk profile and especially the liquidity. When I look at for example, private credit has been a very trendy area in the last
like bubble tea,
like bubble tea.
Yeah.
And when I look at it from the financial stability perspective, I thought there are individual areas that we would need to look at. For example, the lack of data, the leverage that they're having, etc. But I don't think, at least for now, that the industry is creating any systemic risk to the financial system for several reasons. One, if you look at the majority of their investor base, is mostly long-term institutional investor who can sit out through cycles, who don't really have big liquidity needs. So there's not really a lot of liquidity mismatch in that portfolio. The leverage that we see from individual private credit funds is actually not big. They just use the client's capital to lend to those in need. And in a way, they're filling in the need that's left by the banking sector, the more risky part, the mezzanine, and they also go into some of the companies to help them turn around. So I thought the systemic consequences so far is limited, but it's an area that we will collectively in the regulatory forum, we will need to continue to keep an eye on and try to gather more data, especially in a few areas. One is the, as I said, leverage. And second is the interconnection with the banking sector. Will there be more interconnection? So far, currently, there's not a lot. But will in future, the banks and the private credit companies will actually collaborate more by underwriting, by even participating in loans. The third one is whether private credit and private market will be further retailized. If you further sell it to retail market, where people have different liquidity needs. They might want immediate liquidity. When these markets are very illiquid, there will be a mismatch and there will be problems. So I think these are the three areas that we will keep an eye on, but so far is manageable. Plus in Asia, I think the industry is growing, but compared with a very bank-centric system in Asia, private credit is still very, very small, but we'll keep an eye on it.
Yeah, and not to scare anyone, but is more regulation the answer, you suspect?
Well, at least more transparency, more data.
More disclosure?
So you know what's going on there. More disclosure, and for the regulatory community to collect more data on not just private credit, but generally on non-bank financial institutions that cover private market and also, for example, hedge funds.
Right. Just to pivot very quickly, I know we're running out of time. Hong Kong has been very active, increasing its links with the Middle East, back and forth. What's something we can expect to see this year as far as?
Well, we've been actually focusing on two corridors: building infrastructure, building business links. One is the China-Hong Kong Middle East corridor, when we see a lot of trade investments flowing through this corridor. The other is China-Hong Kong ASEAN corridor. Again, China is the biggest trading partner of ASEAN countries. And I was in the Middle East, both in Riyadh and Abu Dhabi, Dubai last year, having bilateral talks with the central banks, trying to create more payment links, for example, infrastructure links. And I was also bringing the banking associations to, for example, UAE, trying to build business links. There's actually a very strong wish of the two central banks to build these links together with us to enhance more trade to be settled, for example, in RMB. Currently, it's all in US dollar. Why not diversify some into local currencies, whether it's RMB or whether it's dirham? And there's a lot of interest in investing into this part of the world as well, Asia in particular, China and Hong Kong. But there needs to be more education. They need to know the means to get into this market, how to use Hong Kong through the Connect schemes to enter the Chinese market. Right. So I think there's a lot that we can do together to enhance this kind of interlinkage between the two regions.
Are there any specific programs that you think would be in place in the next 12, 24 months?
There's one that's already in place, that's already entering the minimum viable product. I thought I mentioned a project called Enbridge last year. It's a CBDC, Central Bank Digital Currency project, trying to enhance cross-border payment, make it faster and cheaper. It's done under the BIS umbrella with China, Hong Kong, UAE, and Thailand participating. And it's a lot faster. It's almost instantaneous settlement, and a lot cheaper than the current cost. And we've already entered the minimum viable product stage using trade settlement as the use case. And UAE is involved. And very shortly, there will be another Middle Eastern country joining.
Okay, I think we're down to our last 90 seconds. I think we have some questions from, on the lighter side of things, Eddie. We'll get to our favorite topic in a moment for the last 10 seconds or so. The advice for young people on building wealth.
All right. It's very hard, but I thought be patient. Don't believe in anybody who tells you that there's a product that's low risk and high return. It doesn't exist. And if somebody tells you that, it's likely that they are scammers and they're trying to scam your money. So you need to protect your savings. That's one. But the medium, longer term, I still believe in diversification. That's actually the focus of the exchange fund, even as a very, very big institutional investor. We're actually clinging to diversification. Diversification is the best way to have a even risk-adjusted return in the long run.
The best investment you've ever made?
Money or
not money?
Because being in my position for such a long time, I have a lot of too many restrictions on investments. So my best investment and the only investment that I have is fixed deposit with many of the banks here. So and you don't want to you don't want to imitate that.
Well, which bank offers the best deposit? Because
many
we can hold them to account. Huh?
You know me, I do shop around.
Anything, last 15 seconds, anything on the Hong Kong peg?
It's not going to change, for the record.
Okay.
Now
you'll give us a heads up, right, in case it changes. All right, that's all we have time for. Thank you so much, Eddie, ladies and gentlemen. Thank you.
All right, thank you very much.
That, I'm sure you'll agree, is a great way to start our program this morning. Eddie, thank you so much. David, thank you as well. As you know, folks, we have a terrific lineup of speakers coming up, but as always, we really do want to hear from you. So let's bring up the QR code, folks. Over the course of the day, we will be running a number of polls. All you need to do to submit your answers is scan that QR code. It should be everywhere. But the easiest way, of course, is just to point your phone to the screen right now and get it registered. Similarly, the QR code is how you can submit questions for our speakers. Our moderators will see them coming in and do their best to weave them into the conversations. Again, as I say, just scan the QR code for polls, for questions, and with that QR code, you can also see what's coming up in the program. So get out those phones. Let's bring up the QR code once again because I am going to pose to you the first poll of the day. Here it comes. Let's bring up the poll on the screen. Which of the following do you think will appreciate the most over the next 5 years? Now, pay very careful attention to that, folks. I'm talking about 5 years, not next week. Will it be NVIDIA shares, Bitcoin, Class A commercial property here in Hong Kong, or an original artwork by Yayoi Kusama? Think about that one carefully. Cast your votes. We'll reveal the results in just a few moments. And while you do, allow me to plug Bloomberg.com. This is the next best thing to a Bloomberg terminal, and of course an exceptional product in its own right, with Bloomberg's authoritative news and data just fingertips away on your phone, on your tablet, on your laptop, or on your desktop. If you don't have a Bloomberg.com subscription already, please stop by my colleagues just outside the plenary hall and speak to our team for a free trial. Now, let's bring up the poll results and see how you feel about those options. Will it be NVIDIA shares? Will it be Bitcoin? Ooh. Wow, what does that say about Hong Kong commercial property? Wow, so the hype is real. The AI hype is clearly real. If NVIDIA is going to be the best performer among those assets over the next 5 years, you folks would appear to think it even fairly, if potentially undervalued at today's prices. One last housekeeping item for everybody. If you are a social media person, I do recognize that not everyone is, but if you are, please join the conversation and engage with us at #BBGWealth. We do want you to tell everybody else who's on social media all the great things that are happening in here, so get on your social platforms and use that #BBGWealth. All right, next up, I would like to welcome to the stage Annabel Springs. She is the CEO of Global Private Banking and Wealth at HSBC. Whoops. Pardon me, Annabel. One thing I learned about Annabel yesterday is that she is an ocean swimmer. Now, to become the CEO of private banking and wealth at HSBC, it seems to me you have to learn how to swim with the sharks, don't you?
And sometimes through uncertainty. If you're growing up in Australia, there are lots of sharks and there's lots of uncertainty. But you just keep swimming and you just keep investing, for those of you who are missing the message at the moment.
Because every bank does it and defines it a little bit differently, I think we should start with the basics, which is where at HSBC is the dividing line between those two businesses of yours, private banking on the one hand and wealth management on the other?
Thanks. And look, before we talk about the dividing line, let's talk about the scale of the business.
Sure.
So if you look at global wealth at HSBC, we're about $1.8 trillion in wealth assets in around 30 countries globally, a little bit over 30 countries. So that's a very big business. In terms of where the dividing line is, generally it sits, we've got obviously the personal bank, then we've got the Premier Bank, and then we move into private banking. And that dividing line is around $2 million of investable assets. But obviously it depends on what people are looking for from a service, and we have to work with our clients and our customers.
Let's talk. I think people would be interested to know, given the scale of the business as you've just described it, what the strategic priorities for your businesses are. Wealth broadly, but of course, private banking is a bit different from those other two you mentioned, both globally and here in Asia-Pac.
Sure. So the aim of the entire business is to be the most admired retail and wealth bank globally for international customers, period. Then for the private bank, we want to be the leading private bank for Asian, international and entrepreneurial clients, again, globally. And we obviously want to be the leading wealth manager in Asia, period. And we believe that we can absolutely do that. I think the more interesting question is how, and particularly what are our competitive advantages? So I just want to outline three of them. The first is obviously our Asia strength. I'd be remiss to be sitting here in Hong Kong and not be talking about our Asian strength. We've been in Asia a tremendously long time. We're deep in many of our markets. We're expanding in so many markets. So for the private bank, we've gone onshore in India, in Thailand. We're expanding, obviously, we've done a recent acquisition from Citigroup in China, really deepening our presence, obviously, and offering wealth now in the Philippines as well. So significant deepening presence in, importantly, one of the fastest growing wealth markets in the world. So absolutely key that we're in Asia and that we're taking that wealth with Asian desks in Europe and in the US and around the world. Key there, international connectivity. You just heard Eddie talk about it, actually. That's an incredibly important part of HSBC. Not only is it in our name, but that's what our clients expect from us. And that's what we deliver, whether it's that Asia to the Middle East corridor, or whether it's the client in Hong Kong who's got the children who are going to school in the UK, going to college in the US, they need a mortgage, they need a bank account, and they want to make sure they get exposure to European and US equities. All of that is something we facilitate, plus, of course, all of their business accounts, which is our third competitive advantage, which is collaboration. We happen to be attached to one of the world's best global business banks with all of the ability to help our clients grow their businesses from innovation right through to multi-generational businesses and serve their wealth.
Across the geographic footprint that you just described, where are you investing most aggressively?
So when we look at for clients or for ourselves?
To build a business.
Actually, let's say we're kind of putting our money where our mouth is along with our clients. So to build the business in Asia, heavily doubling down in Asia. This is a huge region for us.
More so than everywhere else?
I would say it's absolutely a priority for the group. So if you look at where we've put our money, we've launched in India. We've done for the private bank in India, we've launched a business. We've acquired an asset manager in India. In China, mainland China, we have launched a private bank, and we've also reinforced our asset management business there. We're also growing our insurance business through Southeast Asia and our acquisition in Singapore. So we're deepening in all of the areas that you would expect us to be in Asia, but we're also growing in the Middle East because, as Eddie said, huge growth area, a lot of connectivity to Asia, and a lot of investment going there. But in order to be a global private bank and a global business, you need to invest across the entire platform, in people for that personal connectivity, and in technology and investment products and capabilities to make sure that you're, as a bank, you are a holistic service provider for anything that your clients might need.
$1.8 trillion in assets is certainly nothing to sneeze at, but as you well know, there are some true behemoths in this industry. Morgan Stanley and UBS at the top of the heap with $5 trillion or more in assets between their private banking and wealth management franchises. Bank of America is up there in the $4+ trillion neighborhood. I just asked everybody in this room to make a prediction about where certain things are going to be 5 years from now. Where will HSBC's private banking and wealth assets be 5 years from now?
I can't possibly make that prediction in 5 years, but what I will say is when we look at the growth in Asia, our expectation of the growth in Asia is 8 to 10%. Our expectation in the US is similar, and we look at the rest of the world growing on average around 6% in wealth assets.
On an annual basis?
On an annual basis.
This is regionally, not specific to HSBC?
This is regional and not specific to HSBC, and I would absolutely expect HSBC to well and truly outpace that growth.
So in excess of 10+% here, in excess of 10+% in the United States.
We expect to gain market share. So as I look relative to what we expect from market growth, we expect to gain market share.
We will be talking, and David certainly talked to Eddie Yu about some of the geopolitical backdrop. How is what we see playing out across the world affecting the strategic decisions that you make and your appetite for investing in certain parts of the world over others?
You know, one of the things about HSBC is we've been around for over 150 years.
We've seen a few things.
We've seen a few things. Our job around the world is to connect the various parts of the world. So we will continue to invest to connect the various parts of the world and advise our clients as we advise ourselves to continue to diversify and make sure that we're taking advantage of all of the pockets of opportunity and obviously diversifying to manage the risks.
I'm going to ask you a tough question, at least a tough one for this crowd, potentially. The pandemic helped to supercharge the Hong Kong versus Singapore rivalry, particularly the effort by both cities, as you've just heard from Eddie Yu, to attract wealth, and in particular, family offices. Who's winning, Annabel?
You know, Asia's winning. So as you look at that growth rate that I went through, you've seen a tremendous growth in Hong Kong, you've seen a tremendous growth in Singapore, and you just heard me talk about the expected growth. But we also have to remember that we're seeing in mainland China a tremendous growth also there. We know, obviously, we're investing in India. We believe India is the investment destination of the decade. That's an area of growth as well. So one of the reasons that we see our competitive advantage being based in Asia is the wealth across Asia. But I want to be fair and answer your question a little bit.
Okay.
I just want to give you one tidbit that it is really revealing of the growth in Hong Kong, and I think reflects some of the trends and the things that Eddie's talking about. So if you look at the first quarter of this year, we opened more than 130,000 retail wealth accounts in Hong Kong. 60% of those have international needs and are international. So that gives you just a little bit of a tidbit of the growth in Asia, but also what's happening in Hong Kong and the success of Hong Kong in this growth.
There is real competition among these centers, and it's not just Hong Kong versus Singapore. Obviously, the Middle East is doing its utmost to attract as much wealth as possible. Dubai, in particular, is a center that I would highlight. And, of course, London is still doing its part to retain a stranglehold on as much of the world's wealth as it can. And then, of course, there's New York and other financial centers. Eddie just told us that he wants to hear from institutions like yours about what more Hong Kong needs to do to attract as much wealth as it can. What are you telling him? What more do you want to see?
What I enjoyed about listening to him is that he's listening to everybody, right? So what I heard was amounts going up. That's pretty important. I heard channels widening. I heard a discussion around more interesting product. And what I heard overwhelmingly was the importance of looking at what the client wants. So he talked about the importance for rising affluence in Asia in particular, obviously in mainland China, and access to diversification. So I think he's thinking about all of the right things. I was really delighted to hear it candidly this morning. So,
is there any one thing in particular that you'd like to see Hong Kong do on top of what it's already done and what you've heard him say?
I think one of the things that he was saying was this nexus to the Middle East that's really important. So when we look at our business, I would agree with him, particularly on the trade. The bit that we are working on, and we're taking our clients from Asia to the Middle East and from Middle East to Asia, and we've had a series of exchange trips for some of our private bank clients, but also for some of our business clients, is getting the people relationships right. It's really important in Asia to get the people relationships and introduce people. Well, guess what? It's really important in the Middle East as well. I think that's the power that HSBC is bringing to our part of the equation, but also to get those businesses introduced to each other and make sure people deeply understand the investment options across those markets, into the markets too. So we don't just say Middle East and Asia, it's getting into sort of Hong Kong, UAE, Qatar, Kuwait, Bahrain, etc., Saudi. So really understanding more deeply. And that's what I heard him saying, and that's something that we passionately believe and are acting against as well.
There is some evidence, and you may be aware of it, that this rush to sign up as many family offices as possible, or at least in the rush, some people who shouldn't be able to get a registration, either because they're crooks or because they're charlatans, are in fact squeaking through. And I have to imagine that that creates problems for institutions like yours. If you have a registered family office, they'll come to you and say, here's my registration, I want all these services, and then at the end of the day, it proves to be vaporware. Are you worried at all that in this rush, there's the possibility, or the potential, I should say, for something of a race to the bottom?
We have to be eternally vigilant. And this is not a regulatory problem, it's not a bank problem, it's not a country problem. This is everybody in it together really have to make sure that as we build these markets and we build these businesses, that we make sure that we all do our diligence and we build a market with integrity, and we bank the right people in the right way. That is the core focus of all of our banks is trust. That's how banks exist, and we need to work with our clients to make sure that we understand them and they understand us.
We heard Eddie also talk about his interest in creating an opportunity within a regulated framework for more mainland capital to come to Hong Kong. At the moment, mainlanders are limited to transferring roughly the equivalent of about $50,000 a year outside the country. Of course, much of it is coming to Hong Kong. However, it's also clear that much more than that is coming to Hong Kong. And I wonder, how do you handle such situations at HSBC? There's this enormous opportunity to serve the wealth, but perhaps some questions as to its provenance.
We ask those questions, and if we're not comfortable with those answers, then we can't serve.
KYC comes first.
There's an absolute line. And that's our obligation to ask those questions, and we make sure that we do. Because, as I said, the integrity of the market and the relationship between the client and the bank must be absolutely transparent.
Can we talk for a moment about what it is that these clients we've been describing in very nebulous terms actually want from the bank? What is it? You know, again, you heard Eddie talk about the flavor of the month, private credit, for example. Whether it's private credit or other things, what are they asking for?
So, quick set of answers. So, with respect to what are they really asking for, they're asking for global diversification and asset class diversification. At the moment, obviously, they want access to everything, all the appropriate investments around the world, and they want them in every form, whether it's infrastructure or alternatives, private credit, private markets, any form of those things. The second thing they want, though, is global connections, which we also talked about. Absolutely critical, because people are looking to go local, globally. That's what we're providing. The third thing is technology. Make my life simple, make it easy, make me sophisticated. Absolutely important. And the fourth thing that we haven't talked a lot about is purpose. So what is happening right now is one of the biggest wealth transitions that we've ever seen in the world. In fact, period, the biggest wealth transition. People are looking to invest in their legacy, at the private bank end and really think about what does their generations after them look like, their legacy, their philanthropy. But everyone is also looking at climate transition and climate change. So it's all of those four things. Now, in the market, it's a longer answer.
I'm glad you brought up technology because I have one last question for you. No conversation, it seems, these days is complete without some kind of a nod to artificial intelligence. And I can see how AI has potential, as a customer-facing tool or in a customer-facing role at the lower end of your wealth business where people expect some degree of automation. But does it fit into the private bank? It's such a high-touch business and such a personalized business. Is there room for artificial intelligence there?
So you'd expect in retail wealth we're looking at everything, and you're right. So in private bank, the relationship with the personal relationship with the client is absolutely paramount. However, there's tremendous opportunity for AI to make sure that the role of the relationship manager and the investment counselor is as supported with all of the sophistication that we can possibly get to really help them in that relationship with the client. But there's actually also some very cool trading tools out there that our global banking and markets folks are working on. For those of you who know what I'm talking about, AI markets, I think there's lots of room for us to work together, and that's something that we're doing. So I think there's tremendous potential in AI, and everyone should be exploring it, whether personally or from investment perspective, either way, and certainly in businesses.
Annabel, thank you very much. Ladies and gentlemen, please join me in thanking Annabel Spring.
Thanks. Thank you.
And now for our next speaker, it is Sonia Loud. She's the Chief Investment Officer at Legal and General Investment Management. Hi, Sonia. So as you will have noted in the program, we have been asked to take up a very interesting topic, investing in a world without order, something, Sonia, I know you have given a lot of thought to. Let's begin with this, if I may. How is it that investors are? It's not just a matter of whether they appear to be, it's clear that they are so sanguine in the face of such a complex and unpredictable state of global affairs.
Good morning, and thank you very much for having me. And you're absolutely right. If you just looked at the media headlines these days, and you see what's in there, you could get very, very negative. You feel like that the world is falling apart, particularly in some
Tragedies
areas.
everywhere.
It is tragedy everywhere, humanitarian tragedy in particular. And then you look at markets, and it seems it's a parallel universe because everything seems to be going quite well. And I think we have to be very honest that the market is a discounting mechanism, and unless these geopolitical issues really affect growth, inflation, and hence monetary policy, we will not take note. Now, this is the status quo, and we shouldn't rule off that, of course, geopolitical events have the ability to influence markets and, of course, create a lot of disruption and volatility.
Do you see a disconnect?
Right now, we don't see a disconnect because if we look at the economic impact of the geopolitical conflict we're currently seeing, there is none.
On growth and inflation.
On growth and inflation, that is very important. Of course, we are seeing always commodities, so currencies and commodities normally are the ones that will react. But even there, we have seen just immediate spikes, which normally have normalized by now.
As you well know, there are lots of people who make a lot of money warning about geopolitical risk. How do you decide what risks actually matter and which ones are just noise?
That is the art of the possible, because of course you're right. Geopolitical risks and the possibility of a tail risk event has gone up dramatically. So
you believe that?
Yes, and as investors, we should not ignore this. The biggest question for you as an investor is, can I hedge against it? And unfortunately, there the answer normally is no, because it's either too expensive, you miss out on the upside. So what you can...
And impossible to time.
It is impossible to time. The only thing you can do is prepare. Do not try to predict, because so far we have seen with both events, particularly in Ukraine, Russia, and now in the Middle East, I'm not quite sure anyone really would have forecasted. And yet again, if you look at the market reaction function afterwards, if you ignore the volatile element right at the outset, it actually would have been wrong to de-risk at that moment. And I think that is the important takeaway. Now, we haven't even talked about the fundamentals yet, because they will matter a lot more, particularly in the near term. But it is very important that geopolitics and, to that extent, political events very often only have a very immediate, noisy impact rather than a long-term lasting impact.
I will get to those fundamentals in just a second, but I would like to stay on tail risk for just a moment. Is that to say that, A, you don't do any tail risk hedging, and B, the way you described it, it sounds like a fool's errand?
So let's put it in context. We are moving towards a multipolar world, and that is inherently uncertain. And as such means we have to prepare that volatility will be higher. Trying to hedge this, as we just said, and predicting it is close to impossible. So diversification will probably matter a lot more going forward than it has over the past 15, 20 years. That is important to take away, because it is the understanding what a potentially more fragmented world will do to the investable universe and the opportunity set.
The reason I ask is because I would imagine that there are many people in this room who are constantly pitched on out-of-the-money put option strategies.
Surely there is attractive opportunities to do so, but we wouldn't suggest that this is the right investment opportunity, simply because if you look at your time horizon, that is what matters.
Bleed over that period of time?
Absolutely, because hedging only matters if there's an immediate short-term time horizon that you need to meet. Then put options could actually be a very useful tool, not if you're investing for the long term.
So let's talk about the fundamentals. Give us your view, the macroeconomic analysis that feeds your investment strategy.
And that is so important to understand right now, because if I talk about the parallel universe and the disconnect, it is of course the fundamentals that currently matter, and that is driving markets. And we have this beautiful, let me put it this way, beautiful triangular relationship between growth, inflation, and monetary policy, which has been so supportive to risk assets around the world. Why is that? We have had very resilient growth, particularly in the US and, of course, in India, and obviously with the news overnight, that is an interesting topic to look at. We have had inflation that clearly is coming down, but obviously now proves far stickier than originally expected. And we had the expectation far stronger at the beginning of the year that we would see a number of rate cuts. And that, of course, has fueled risk assets, equities in particular, because that is kind of a Goldilocks scenario. Now, what is the risk? The risk is that the path is incredibly narrow. And if you currently look at consensus forecasts, they all sit in a very small square of expected growth and inflation. And that always should at least raise a little flag that there is risk potentially to such a narrow forecast. But it is so far a very decent path, because we have inflation that's coming down, we have growth that is approaching a soft landing, and we have at least the expectation of rate cuts. I think the ECB probably will go first.
You mentioned equities. We've seen a pretty substantial expansion in the multiple on stocks in the past several years. Is there any value left in equities?
So, yes, you're absolutely right. We have seen highs in most equity indices. We're not at the highs in earnings. So you're absolutely right. Multiple expansion has been a big part of the positive return profile of equities. But we have seen earnings growth as well. So there's not a complete disconnect, but what you are seeing is, if you look at the equity returns versus the fundamentals, you are seeing that equities are quite a big step ahead of what the fundamentals are telling you. So equities have clearly bought in the idea that growth will remain very resilient, and as such is always forward-looking in what is about to happen. That's another little risk flag, because if, of course, particularly on the manufacturing side, you will not see that strength coming through, you might see some disappointment in future earnings.
And if you do go looking for value in equities, which of course you do, where are you finding it?
It is very much thematically driven, and of course the elephant in the room, which I'm sure everybody's interested in, is the Magnificent Seven.
I was just about to get there.
I know you would. This is why I thought I should get ahead of you. Because they are clearly such a big driver now of the market, and yet we're seeing at least some disconnect. If you look at one of the Magnificent Seven, they obviously didn't have a very good start to the year. But I'm sure the question is there a bubble? And if you look at the fundamental earnings delivery of these companies, no, there's not. They have incredibly strong balance sheet. They're normally cash positive. So what you normally would look for, obviously, before we are seeing stress in the market is those signs. Yet, do I think that they will be the drivers again? No. If you look at history, then it is not a given that, your winners of the past, of course, will be the winners of the future. We all use that disclaimer. But the importance is if you strip these out, valuation levels do not look stretched. This is the importance. Headline levels are normally not a good guide to find investment opportunities. So it is far more to understand structural drivers. We had a lot of hype around obesity drugs. We have seen, hence, in Europe, pharma companies benefiting the most. We're looking for the growth opportunity and the shift in the growth opportunities. We just heard from Annabel the idea of decarbonization, the transition to a green economy. These are structural drivers that will fuel opportunities that we are quite keen to look at.
We are in the early stages of what could be a massive reorientation in global trade. How are you pricing that into your investment strategy?
That is a very, very important factor. It's difficult to price immediately. So this is all about understanding, putting yourself in the shoes. If you're running a multinational company, how are you thinking about your global supply chains? How are you thinking about potential risk premium of operating and producing in specific areas and specific countries? And does it require you to make changes? So is there disruption arising from a potential deglobalization pathway, and how do you react to it? Again, there's risks, there's opportunities, but it's understanding these. We had a first taster, right, during the pandemic of what it means if you disrupt global supply chains, and I'm pretty sure this is used at least as some sort of a blueprint for companies to potentially rearrange themselves.
So we've now addressed trade reorientation. You mentioned decarbonization. Do people appreciate how inflationary the de-risking or decoupling from China, coupled with the energy transition, actually is?
No, it seems that we still believe that we're going back to the normal inflation pattern, if there is anything like it, because let's face it, the period prior to the pandemic and the inflationary shock was everything but normal. And so I'm sure the market is still grappling what a normal inflationary environment should look like. You haven't even mentioned politics and fiscal policy and everything else that we are seeing, because
glad you're weaving it in.
We're coming to the US election, I'm sure, in a minute. But you're absolutely right. It is the understanding of how these will change the inflationary backdrop. We did run the analysis, particularly on the energy transition. It is inflationary, all else equal. Of course, there's always adaptation. We are changing as consumers, but you have to assume that there's quite a lot of inflationary pressures in the system. And as such, it's very interesting if you consider where we've just started beginning of the year, it's not long ago, and we were expecting 6 rate cuts from the Fed, and we're now talking about flat to potentially up. It is an almighty shift in the way we're looking at inflationary pressures.
That period you referred to between, say, the global financial crisis and the pandemic was indeed a historical aberration, and not just in terms of inflation and monetary policy. Are we living in a new regime? It appears that we're living in a new regime characterized by geopolitical risk. There's more inflation, and with it, as you've just explained, higher rates. What else belongs in that characterization of the new regime? Is it, whatever we want to call it, neo-populism, illiberalism, what we're about to see play out in the U.S. election?
Not just the US, I've mentioned the India election already. It is very interesting in the way we're seeing the electorate responding. There is a few commonalities across most of the elections. Inequality is one of them, where we're seeing a level of backlash now globally to the implications, and of course exacerbated by the cost of living crisis on the back of the inflationary shock, where we are now seeing protest votes being put forward towards the incumbent politicians or parties in general to say, things need to change. The focus on, growth and the global approach has not led to a more equal distribution in society. And with the cost of living crisis, you're fully exposed now, the level of inequality. We're seeing this in Europe with a big shift to the right. We're now seeing it in the US play out. But even in India, I'm very sure inequality played a big part why Modi couldn't extend his majority, because India is such a lopsided country as well, where the level of poverty and energy poverty, for example, as a starter, is just still so pronounced. Unless you have sensible policies to put forward, I can see why people say we need change.
Heading into this Indian election, were you overweight or underweight India, and what are you doing now?
So we were very excited because obviously the inclusion of the government bonds in indices is still a big deal. It is too early to tell. We've seen the equity reaction yesterday, which is normal because it's clear that he will need to acknowledge that there has been, to some extent, a protest vote, and that the pro-growth, pro-business reforms probably need to give way or need to be balanced in trying to focus on what he has heard. So that would not necessarily be business or equity positive, but let's face it, the stock market had such a decent run. It, for the time being, just takes the froth off. We are still very excited because, of course, the inclusion of the bond market means it's just the opening up. We haven't seen India being a major participant because it was very difficult for foreigners to participate. So again, too early to tell. We are not changing, and of course are still excited about the inclusion of the bond market.
It is easy to talk about geopolitics because it is so in our face, but I do want to give you an opportunity to talk about something else that's fundamental to your investment strategy, and it's a term that you use, which I find quite amusing, granola. Explain.
Yes. It's the European answer to the Magnificent Seven. But it's the healthier option because it's mostly pharma and healthcare. You might know that actually Novo Nordisk now is the largest European company, and they are a major beneficiary of the obesity drug. So it's Ozempic is the main name or trade name, let's put it this way. And of course, there has been a lot of excitement, not quite at the level of AI. I give it to investors, but it is really about the idea what we could achieve if Ozempic really is delivering what so far it seems to do. Because if you then consider the potential positive side effects around diabetes, heart-related diseases, so there's a lot we can think about. And this has actually fueled a lot more of the excitement in Europe than, of course, AI has in the US.
Do you think it'll get its day?
Yeah, no, I think so far so good, and we are seeing, of course, but it is very important fundamentally if you look about the opportunity levels. The US, of course, has surprised us because it has been so incredibly resilient, and we are now looking, particularly in the upcoming election, on signs for fiscal policy, because I've mentioned it earlier. The fiscal deficit in the US is at a level now where I'm very sure the market will focus on what the two parties will say on the extension of fiscal policy, because eventually we will come to the point that the bond market will say, we are happy to finance your fiscal deficit, but we want higher yields, particularly at the long end.
You think the bond vigilantes are coming back?
No, at least some term premium. Let's not call it vigilantes, okay. But there's no term premium right now. There's nothing factored in for the idea that both parties actually seem very pro-fiscal. Now, Europe is coming from the other side because their growth has been so anemic that with now a slight recovery, you probably have a little bit of it's a different level of excitement. One is still expecting for the overstimulation of America to continue, whereas in Europe we've obviously been at the extreme other end with Germany driving the austerity narrative, and as such, not having had the same positive impact on the economy.
Sonia, here's where I'd like to end. You're an active manager. Active management is hard. With more and more technology finding its way into financial markets, whether it's machine learning or now generative AI, do you feel more optimistic about the prospect for delivering excess return alpha as an active manager, or is it going to get harder still?
No, I'm very excited actually, because I think AI can be an incredibly enhancing tool to the investment process. in a way that you just have to be far clearer where you want the human to add value and provide the value add. Now, having been an active fund manager myself, you normally lose the alpha in the areas you haven't focused on, not the areas you have focused on. So if you can use AI to help you with the portfolio construction process for you to focus really on what delivers the value add, I think that's a perfect combination. And let's face it, particularly when it comes to the integration of responsible investing factors, that's where I would like my team to focus on, not necessarily on the overall portfolio construction, and that I'm very excited about.
Ladies and gentlemen, please join me in thanking Sonia Loud.
Thank you so much. Good to see you.
Please welcome to the stage Amy Lo, Chairman, Global Wealth Management Asia and Head and Chief Executive Hong Kong at UBS, for a conversation with Bloomberg's Stephen Engel.
Good morning, everybody. I am Stephen Engel, and of course, this is Amy Lo, who probably needs no introduction in this room. 29 years at UBS.
Yes.
21 years at Bloomberg. We should have a lot to talk about today.
I'm sure.
Obviously. So
Thanks so much for having me here.
Well, thank you for having us. All right, being here. So I've been told that you love, among many things, three main things. You love your dogs.
Yes.
You
I
love-
have 6 dogs at home.
You love golf, and you love wealth management. We're going to talk about one of those today, obviously. 29 years experience. It's been a bit of a rough year for the Chinese, or last 3 years or so for the Chinese economy, obviously. There has been some wealth creation, but probably some wealth deterioration as well, as you really target those ultra-high net worth individuals. What is your biggest piece of advice now in a changing geopolitical landscape, as well as a lower growth environment in China for when you recruit that family money and the high net worth individuals?
Perhaps to also echo what Eddie said earlier this morning, diversification is the key. Because one thing for sure is volatility is definitely here to stay. And so we've been also advising the client really doing proper asset allocation. But what we've been observing down on the ground, talking to the client, because we just hosted the Asia Investor Conference with 3,300 participants and 300 corporate coming to Hong Kong. And I can sense that the mood and the sentiment changed a little bit.
To what?
Relatively more positive on China and Hong Kong, because last 2-3 years have been tough. And we got also more questions on investment in China and Hong Kong. And as a matter of fact, for our house view, we also put China as one of the preferred market, because given the valuation and also the supportive measure from the government and also some of the relaxation from the regulator, that helped. And so if you look at Hong Kong, also rebounded. So obviously the question is that sustainable?
That is the next question, because there has been a little bit of policy fatigue as well. The markets did rally since those February and January lows. But again, it's also kind of plateaued a little bit, at least the equity markets have. So what more would you like to see for confidence-building measures, either from Beijing or other authorities?
The continuous kind of supportive measure, that would be helpful. And obviously, what we have seen this round is that, for example, with the rally, you have also some of the long fund coming in. And talking to some of the institutional clients during the conference, we have seen that kind of interest. And that sort of interest and fund flow is definitely also necessary. But for them to come in, the supportive measure, the sentiment need to improve. I think that helps. But back to your earlier question, obviously still diversification. I think what we have seen, other than interest relatively turning more positive to equity and stay invested, the other thing is also fixed income. With the market volatility, the investor also turn to fixed income, locking some of the compelling yield. Actually, that also echoed very well with the Global Family Office report we have just published. We interviewed 300 plus global family offices and 1/3 in Asia on what are they doing now and also investing. Actually, 25% of the asset from these global family offices, and especially from the Asian, also said they will be investing, they are putting 25% of their asset into fixed income versus 15% of last year. And another asset class that's also getting very popular, and Abby also talked about earlier, is alternative.
Which alternatives?
Private equity and also hedge fund. For example, our hedge fund sales increased by 40% year on year. And again, if I may refer to the GFO report, the Global Family Office report, 74% of the global family offices were saying they are investing in the alternative, and they will further increase their allocation into the alternative. And another interesting asset class we've been seeing is gold. Really a lot of interest from the family offices in gold, as well as physical gold.
That's part of the safe haven hedge.
Yeah, the geopolitical, given the geopolitical kind of situation. So some of the family offices also have been diversifying into gold. Actually, what we've been seeing is not just the last few years, because for some of the top family offices, that has been an asset class for quite some time, but it has been picked up quite more widely and broadly by the other clients as well in the region. So that's what we've been observing.
What would you observe as far as their risk appetite right now? Because I guess you could safely say that a lot of these high net worth individuals in China over the previous years, before this sort of correction over the last 3 years or so, have been more risk. Their appetite for risk was much higher than the norm, right? So they would go into less than investment grade bonds from property developers, junk bonds. They would, borrow on margin quite higher than most in equities. They've had to pare back some of that risk, haven't they?
Yeah, certainly. I think they learned the lesson well, and so especially given last few years, what happened with the property market and some of the high-yield bonds. So instead of being, in general, in the past so many years, they've been quite home buyers. They're really looking at global diversification, both in terms of jurisdiction as well as asset classes. But obviously, Asian clients are also very versatile.
Yeah.
So once the opportunity comes, then they will also look at, but all along we've been saying is, core and satellite. You still have to have the core, proper asset allocation. And then for satellite, then you can venture into some of the themes or opportunistic idea that you can capture the market flow.
So those trends will be to where? I know your co-head in Singapore is looking at India, looking at Australia. Obviously, the Fed and the yields there have attracted lots of investment, but the Fed might not be, tight for so long. It's higher and for longer, but when it turns, what could be the returns back to this part of the world?
Yeah, I think that's the reason why the asset allocation is so important, and really keep versatile and be able to capture some of this opportunity. And to your earlier point, that's also what UBS has been doing, especially with the integration now. It's very complementary because historically, UBS is very, very strong in the Greater China region. So with the acquisition, actually it adds into a book the India, the Australia, and also potentially Thailand and some of the Southeast Asian country. So I think for us, Hong Kong and Singapore still are our core hubs in Asia. And then our strategy is how we're going to also expand and further grow our established market. That includes Taiwan domestic, because we are the biggest foreign bank in Taiwan domestic, Australia, India, and also APAC Switzerland, because we have over 100 plus bankers from Switzerland covering Asia, and 60 of them speak Mandarin. So that's the kind of franchise we have. And then long term, how are we going to grow China and India? Because these are the two biggest growth market in the region as well.
Speaking of the family offices, what still needs to be done, if we talk about this home market here, to attract those family offices that might have left, or trying to get them to come here? Because a lot of the wealth, obviously, with this generational transition that we're expecting, because a lot of, I think 2/3 of the billionaires in China are entrepreneurs. They're first-time money. They need to pass it on. And over the next decade or so, we're going to see a lot of wealth transition to the next generation. So what's the opportunity at hand for Hong Kong?
Oh, there are a lot of opportunity. Talking about the wealth transfer, you're talking about 2.5 trillion asset that will be transferred to the next gen by 2030, according to the WealthX report. So there's a lot of potential for private bank like us to provide that kind of services. So obviously, I think China remains to be one of the top market, because we conducted the survey to all the members bank, because as a chair of the Hong Kong Private Wealth Management Association, basically all the executive committee and the members bank have been telling us China remains to be the biggest growth market. I think what the government has been doing with the capital investment entrance scheme that Eddie talked about earlier helps, because right now we already receive 150 applications, and we also got a lot of inquiry. And actually, my 30-year plus experience, I've been also witnessing a lot of family office set up in Hong Kong. Multi-thousand, okay, a few thousand. But how are we going to also even attract more to come in? And that's where, again, Eddie referred to this morning about the multi-corridor, the Middle East corridor, the ASEAN corridor, and in addition to the China market, okay? So I think that's also the different scheme, tax scheme will be helpful, because one of the strengths of Hong Kong is the low, simple tax scheme, and also the very well-established regulatory system to protect the investor, as well as the connector, being a super connector, the connectivity that Hong Kong can bring through all these different corridors. I think that will be very helpful.
Did you hear anything from the HKMA, Eddie, this morning on what kind of changes you'd like to see and expansion of the Wealth Connect?
Yes, and actually that's also something we've been advocating and proposing to the government on behalf of the Hong Kong Private Wealth Management Association, because right now, even with they raised the quota to 3 million renminbi, that's not really the segment for the private bank yet, because especially given the PI regime. So obviously the quota is an area that we need to further increase, as well as the product offering, because I think one of the strengths of Hong Kong is also the advisory capability, plus also the kind of breadth and depth of the product offering and the platform here. So how we can leverage on those. And the other channel, which we also discussed, because right now is more execution only. So how we can leverage on Hong Kong's strength being on advisory. So we've been also exploring potential advisory licensing within the Great Bay Area. So that's also something the industry has been looking into.
But that should be something that Beijing would be open to. They want to create this single market, if you want to call it, with still boundaries, obviously, with Hong Kong, of the Greater Bay. So what are you pushing for to get that license
That's
approval?
something we are exploring, and also have been discussing with the industry and also with the regulators there.
Tell me how your plans are affected by, obviously, the integration of the two parent banks now. I understand it's pretty much complete, and that Asia is going to be your priority. Hong Kong first, then Singapore and Japan. What are your plans?
The integration so far goes on well, and this is unprecedented and historic, despite the fact that this is not the first time I went through the integration with 29 years. Actually, the first one was between Union Bank of Switzerland and Swiss Bank Corporation, the two biggest banks in Switzerland, and I was from HSBC. So it goes on well, and actually we just completed the parent bank merger on May 31st. And that allowed us to really deliver the service to our client with a fully integrated team from UBS and CS. And that definitely helps. And then, as you said, then we will have the system migration and the client migration. Hong Kong will go first, followed by Singapore, and then the rest of the world. And so we are very excited because this is really the power of the two, very complementary, both in terms of the platform, the offering, and the expertise there.
Obviously, in the banking community here in Hong Kong, there's been a bit of a confidence crisis. Almost every bank has laid off some employees, including UBS, I believe about 70. But you have one of the biggest portfolio of wealth management advisors, more than 1,000. You also have, more than 600 billion US dollars in assets under management. When do you see the confidence returning to the banking sector here where it can start growing again and adding headcount?
We continue to invest in Hong Kong for sure. I think the fact that, we signed a lease for 10 years, actually it's 10 plus 1, to move to West Kowloon. It's a major commitment. If we don't see the potential and the growth, we won't commit such a long-term lease for Hong Kong, in Hong Kong. I think the reason why we moved there, on one hand, because right now we have for almost 4,000 people in 5 different places. So we want to put everybody under one roof and have our new home there. And on the other hand is that we are also very positive on the Greater Bay Area. So on West Kowloon, right about the high-speed train station, 3 minutes, I'm down on the high-speed train and connect to the rest of the world, west of China. So I think that's a major kind of commitment, and that speaks for itself, the kind of potential we see out here. And we are still looking at hiring selectively, and also definitely, this is a growth region, as announced by Sergio, US and also China and also Asia as a growth region for UBS.
So it's a beautiful building designed by Zaha Hadid. So obviously a pioneer, a female pioneer, and that's something that's very close to your heart. Getting more women onto boards in Hong Kong. Obviously there are lots of women in extremely important positions, including my next guest later in the morning, and that's going to be Bonnie Chan of the Hong Kong Stock Exchange. But how important is it to get more females in Hong Kong on boards in charge of wealth? My family, my wife's in charge of our wealth, and it works.
Something I'm very proud for Hong Kong is that as a founder of the Women CEO in Finance, we have over 60 women CEO in finance. And these are talking about some of the big banks like HSBC, Citi, Standard Chartered, UOB, UBS, and ICBC, even some of the Chinese banks, and SFC, and Hong Kong Stock Exchange. I know you've been talking to Bonnie, but I totally agree, we haven't done a good job yet on the board's representation. The women representation in the board in Hong Kong is 18%, despite we have an increase from 17 to 18.5. So that's definitely the efficacy. We are now pulling the resources together to change, to lobby, both on the policy and also how we make it easier for women to excel, be it in the finance or in any of the career they chose for. But one thing though, if we look at the World Bank report, actually Hong Kong scored quite well, 65 out of 100. And that kind of score basically is to measure the supportive framework for example, like Hong Kong as a city, to women in terms of in the area of protection or pension. So it's not that bad, and that's above the average, global average of, I was told, 40%.
We have 20 seconds left. It's not enough time for this last question. Since we're taking your advice on where to invest, what's your best investment you've ever made? And it doesn't have to be a financial product.
Alternative. Personally, I also put quite a lot of 30-40% of my own small account into alternative, the private equity fund.
Okay, there you go. Right, like the Shinkansen train, right on time. Amy Lo, thanks so much for your time.
Thank you so much. Thank you.
Please welcome to the stage Adriel Chan, Chair at Hang Lung Properties, and Ronnie Chan, Honorary Chair at Hang Lung Properties, for a conversation with Bloomberg's Lulu Chen.
Welcome, Ronnie, Adriel. China property is in the spotlight with the central bank unleashing $42 billion for a re-lending program to buy unsold homes. Will the stimulus be enough, in your opinion, to put a floor under the spiraling property market?
I think the problem is so big and so complicated that it is not one single action on the part of the bank, of the country, that can really resolve the situation. So I think it's a step in the right direction, but I think there's a lot other complementing element that needs to be there. For example, moving forward, how do local government get money if you cannot no longer sell land like they have done in the last 20, 30 years? So there's a lot of pieces to it, and that's a good, useful piece to it.
Well, you're very China-centric, so as a property developer there, what would you like to see more from the government to ensure the future of this market?
Well, for our business, we really don't need the government, in a sense. We are not residential developers, so that's their problem, not our problem. And the private developers' problem, not our problem. So from our perspective, just leave us alone. In time, we will come back and we'll buy more land. Well, that's his problem, not mine. I'm shedding everything. But that's the reality.
As Ronnie mentioned, we're mostly in the discretionary high-end retail, so that's a very sort of different set of market dynamics. What we're really looking for is confidence. When the consumers have more confidence, especially in the first-tier cities where sales are actually lower than in second-tier cities, the first-tier cities need a confidence boost, and when that happens, then I think the consumers will come back.
Well, speaking of longer term, and also something for you to think about, Xi Jinping the Chinese government has talked about affordable housing multiple times and the need to shift to a new property model. Now, what do you think the future of property would look like in China?
It'll be very different from what it was the past, decade or a couple of decades. I think it'll be healthier. It'll be more sustainable, both financially, but hopefully also physically. That's something that we're looking at. Obviously, we're not the big, massive developers doing a lot of residential that I think you're referring to. We're on a much smaller scale. But I think that the market has to change. It's not going to be as sort of a sure win in terms of investments. One of the reasons why property was so important to the Chinese economy, one of the reasons, was because it was one of the few investment tools. Amy just now talked about, her best investment was in alternatives. And in China, I think most people's best investment has been in the alternative of real estate, rather than in the stock market, which was relatively underdeveloped and not really reliable. And so everybody had put their money into real estate. And I don't think that will be quite as certain for retail investors as it was in the past.
Yeah, definitely at a shifting point in time. And for your company specifically, we mentioned that you're Hong Kong, China specific. Currently, your price to book multiples and share prices are under pressure. What's your take on that?
Well, first of all, I don't think there's any pressure. Everybody's in hell. Everybody's selling at 0.27 or whatever, which is ridiculous, obviously. So if everybody's selling at that level, we're selling at that level, well, I understand why we're selling at that level. I'll let Andrew explain it if he wants to. But for other people, it's different reasons. You shouldn't really be talking to me because I have a pretty bad track record. Just tell you guys a story. 15 years ago, 21 real estate developers from mainland China belonging to a real estate association came to see me in Hong Kong. And I told them, I said, if your association has 100 members, in 15, 20 years, 20 of you will make a lot of money, and 5% of the total will make tons of money. And then 50% of you will be gone, will be bankrupt. The rest of you will be okay, but it won't be particularly good, particularly bad. I was totally wrong. I said 15% will go bankrupt, 95% went bankrupt. So my track record is terrible, you know, so I better shut up and let the younger generation talk.
I think more broadly speaking, in this part of the world, all the real estate developers are underperforming. All of our price to books are very low, and there's many reasons for that. Obviously, there's a huge China discount. There's a huge real estate sector discount. And then, of course, as we all know, a lot of capital has not been flowing into Hong Kong or mainland Chinese stocks. It has been flowing out. And for that reason, that I think is the main reason why our valuations are so low and so sort of despicable today.
And what does that mean for your strategy? Have you thought about shifting geographic focus or strategy?
Well, I mean, for us, it means that we're probably not going to be tapping the stock market anytime soon at this valuation, first of all. But it definitely does force you to look at the market a little bit differently. Interest rates, I think, have a bigger impact than our valuation on our decision-making. And when you're in a high interest rate environment, which we are relatively speaking today, that definitely is going to cause you to slow down or reconsider some of your big investments.
And for your malls in China, with the consumption rate down, what are you doing to boost sales there?
Well, first of all, consumption is down on last year. Last year was a record year. We're roughly back to 2022 levels. And 2022 was a record year. You know, during COVID, many of you will remember, actually mainland China luxury retail sales almost tripled. So we're at a very high base right now. So yes, we've come down half a notch, but we're still doing very, very well, much better than pre-COVID, something like more than double pre-COVID. So first of all, the baseline is that we're actually not doing so badly. And I think that, you know, we just have to make sure that we're investing appropriately. We've done a lot in terms of getting closer to the consumer, and I think that each industry will have a slightly different approach, but our approach has been to really try to own the customer in a way that we haven't done, that landlords haven't done previously.
I wanted to touch upon something that you mentioned earlier, the flow of money into Hong Kong and the pressure that the city is facing as a whole. With Hong Kong standing on the front lines between China-US tensions, there's this rhetoric growing from the U.S. side that Hong Kong equates China. And how should we view these risks of the global community no longer seeing Hong Kong as international, and how to address them?
Well, the risk is real. America is stopping a lot of money from flowing to mainland China, and because Hong Kong is now part of China, so they don't want them to flow to Hong Kong as well. So it's all politics. So let's make sure in our own head that we get it clear that something is real economics, something is political. And political things, the wind changes. But it may not change quickly, but sooner or later it will change. So let's not look at a political event and think that it is an economic event only. Of course, it affects the economy, and it affects our business and many others' business. But it's really a political dimension to it that is, you know, beyond our control. I think over time, the whole world will have to readjust. The whole world will have to rebalance. In what shape and form, we're not 100% sure. I have some thoughts, some ideas on it, but you know, it's not going to be the same as before. And so let's make sure, my message to everyone is, let's make sure that our heads are clear. What is political and what is purely economical. And so, you know, when it comes to political market, wow, it's a wild place. So.
And tying this issue back to Hong Kong property, the residential prices are at levels even below before the government scrapped all the buying curbs. What do you think is the reason behind this?
Well, first of all, I think a lot of people don't analyze the fundamental economic reason why Hong Kong's real estate market is being challenged. To me, it's a rather simple one. I've been observing this market, and I've been playing in this market for the last 40-some years. First of all, under the British high land price policy, they still deny it, but it's crazy to deny it. That way, the British companies can repatriate a lot more because less tax here, and because of the high land price policy, you don't have to have high tax here. So they can repatriate more. For Hong Kong people, it's not a bad thing either. You know, wealth effect make people feel good when the real estate prices go up, and the government can have low salary tax as well as corporate tax. So there are many good points. So the British is the first one that really kept real estate prices up. The second one is Beijing. In the negotiation of 1997, Beijing was afraid that the British will sell a lot of land at high prices and take the money out. And so they make sure that there's only 50 hectares per year of supply. So with limited supply of land, prices continue to go up, number two. Number three, the Hong Kong people. 60% roughly of Hong Kong people own their own homes. We don't want to see prices fall. And real estate has become such a big thing in the economy. You use it to mortgage and start a business somewhere, for example. And then finally, the yellow ribbon people, the anti-government people, the so-called pro-democrat people. They're not Democrat. Don't be fooled by them again. Anyway, so those guys, anything that Hong Kong government want to do, anything that Beijing want to do, they say no. So the Hong Kong government want to sell land, and they say no. So, you know, they probably hate developers, those guys, but they ended up helping the developers to keep prices up. And so when you think about it, for 50 years, starting roughly in the 70s, that these four groups of people have limited the land supply of Hong Kong. And as a result, there's no place to go for real estate prices is up. However, with the 2019 riot on the street, which is so violent, it's unbelievable. When it's so violent and the police is so restrained, I just want to clear it again in history, that those guys are now, because of the national security law and before Article 23, so the opposition, which is purely for political reasons again, not economic reasons, they damage Hong Kong economically for their own political gain. So as a result, once that is removed, for the first time in 50 years, that the Hong Kong government can finally supply land in a more reasonable, more economically sensible way. That means more sufficient. And so when that happens, after 50 years of high land price policy, how can real estate prices not come down? So what's the big deal? Now, of course, I know if you own an apartment, that's a big deal. Or if you want to buy an apartment, well, and you're happy. It's a big deal too. You're happy. But overall, when you look at the economy and look at the Hong Kong real estate sector, we are seeing the biggest structural change in 50 years. And so for prices to go down is to be expected, right? Isn't it? It's so clear.
What does that mean for the developers and the big families here?
Again, that's not my problem. You invited the wrong guy to come and speak. In Hong Kong, we have basically rental properties, and we're suffering. Office prices down, retail prices, okay lah. So we don't sell that many residential. I think that some very honest developers have said already that we're not going to buy land anymore. Well, if prices come back, I think they will. But fundamentally, because the market has changed, so the behavior of the developers will also change according to the environment outside. And so what will happen to them, I don't know. We'll see. We will see. You have some developers that are cash rich. Are they buying? I think some of those guys will buy, but there are also others who are quite strapped for cash. So I think the market is really evolving. I don't want to jump to a conclusion when I don't have enough visibility.
Maybe I'll just add one very quick thing. You know, we're mostly in the rental properties, and we do see rents coming down, especially in offices, but a little bit in retail too, especially since COVID. So retail rents are way down. You know, frankly, I think that's good for Hong Kong. We need that space. I think business owners, business founders need that space to experiment, to offer better experiences to tourists who come to Hong Kong, to locals who choose to stay in Hong Kong to consume, rather than go up to Shenzhen or elsewhere, or Japan. And I think that, when they have that extra cushion, we will start seeing some more interesting everything from F&B to services to retail. And I think that's something that our city desperately needs.
The issue that, Ronnie, you bring up about developers no longer buying land, would that have an impact on the low tax regime in the city?
Well, the low tax is enshrined in the basic law. So it is not something that anybody can meddle around with it. We just have to find other ways to make ends meet. But as Adriel said, it is inevitable that a lot of prices will have to adjust after 50 years of a very man-made, artificial high real estate price. Of course, China opened up, so Hong Kong economically benefit, so we can sustain the high price for the time being. Now, as you mentioned, mainland China is also having economic challenges like the rest of the world, Hong Kong also. And so the whole structure of the real estate is changing so fast. Not to mention, as Adriel talked about it, that now going to Shenzhen to buy things, right, to consume on the weekends. I said, what's a big deal? Such as grow up, such as economic reality. In the old days, they used to come to Hong Kong to buy because, the quality is better. So now their quality has gone up, and price is still, differential is big. So Hong Kong people go back there to spend. I think it's a wonderful thing. Now, it hurts me because the retail prices, retail rent has no place to go but to come down. And the whole asset value has to adjust in Hong Kong. That's just a fact. If you don't accept it, if you don't recognize it, then I would say, you will be a very sad person, very unhappy person. But if you rationally understand it and accept it and say, okay, what do we do? What do we do in order to get the best out of the present situation? And so with Shenzhen opening up, I see very good things. For example, Hong Kong people's Putonghua will be a lot better. And I have been singing this song for the last 20-some years, and that is, politically, one country, two systems. But economically, you got to integrate with where the money is. 50 years ago, 60 years ago, America was hot. So we all gravitate toward America. We all learn to speak English and deal with America. Then Europe rose, and then Japan rose. And we had to deal with every one of these. In the last 30 years, who has been China has been accounting for some 32% of the world's economic growth for a long time. And so if that's where the money is, what's wrong with looking to the right direction? The dumb people, the yellow ribbon people, they hit people from mainland China carrying a bag. Those guys are here to spend money, and then you chase them away, right? So the same guys who hit those yellow ribbons who hit the mainland shoppers in Hong Kong, today themselves, damn it, are going back to Shenzhen to consume, right? Let's hope that nobody will hit them. So such is the change in this part of the world that is just amazing. And I think we need a cool head. Don't use the old paradigm, the old economic paradigm to understand Hong Kong. In a sense, it's an anomaly, as I said. 4 parties make Hong Kong real estate prices stay high for 50 years. When that is fundamentally changed, everything changes. So let's get our hair adjusted to a new environment, accept it, and do the best out of it. I still think there's tons of opportunity to make money in Hong Kong. The private bankers, all 3 speakers before us, they were all talking about money flowing down. It's true, it's real, right? So Hong Kong still has a lot of opportunity. So let's look forward instead of backward.
This adjustment period where we see right now the new homes are actually selling cheaper than existing homes, and also the adjusting to the new reality that you mentioned. How long do you think this period will last?
It will last as long as it will last. But Hong Kong tend to adjust pretty fast. But this time the difference is people don't feel, you have to take care of the consumer's psychology, right? They don't feel too assured of the future, and when the home go down in prices by, I don't know, 20-30%, it's going to affect your consumption pattern. So a lot of things are happening. Frankly, a lot of banks are holding the bag for a lot of speculative real estate of the last couple of years. So the banks will have to adjust, the individuals have to adjust. I'm all for looking forward to see what the brave new world of Hong Kong is going to be like, and we will still be here. We have, 40% of our rental income every year, roughly $40 billion is still coming from Hong Kong. So, we will ride this one out.
And I'd like to ask about succession. From Ronnie to Adriel, how has the transition been?
Ask the shareholders. The share price hasn't been doing particularly well, so I think that their vote is pretty clear. No, I think
ask Amy.
Yeah, ask Amy. She'll have a better idea. I think it's been pretty smooth as far as I would say. I've been involved in the business for 14 years, and it's not like I'm not unfamiliar with how things work. It's just a change in psyche, both for management and also I think for our outside stakeholders. And that'll take some time to adjust. It's very normal. But more or less our business is business as usual.
When you think about the future of your company and the legacy, what is the vision that you have for where you're taking
the world is a very different place from where it was just 15 years ago when I joined the company. So you have to be reactive and you have to be faster on your feet today, I think. These grand strategies that we've implemented over the past couple of decades have paid great dividends. But I think that the way we look at the market going forward has to be different because the market's different.
Can you be more specific in terms of how?
So we used to do a lot of big greenfield investments. Those took decades, literally decades, to repay. And I think that the size of the projects may have to get a little bit smaller. There's many ways that could happen. And then also the markets maybe are less so greenfield. Maybe it's going deeper vertical rather than horizontal. So these are things that we've been talking about and looking at internally. I think they're sensible options, but at this point they're just options.
I just add one thing to what Adriel said. When everybody's in hell, there must be opportunities. Isn't that, 10 days ago I hosted Jamie Dimon in Hong Kong with a couple hundred people. And that's what John Pierpont Morgan said, when there's blood on the street, hey, that's the time to buy. And you go to the mainland of China today, the government local government don't have money, the people don't have money, nobody have money. Hey, that's great, I got a few bucks, right? And so there must be opportunities, but as Adriel mentioned, don't look at our past and say that's the immediate future. The opportunities are not there. Well, it's there, but we may not want to take it. These big greenfield projects, but there are a lot of smaller opportunities, vertical as he calls it, that are just, the return is very, very lucrative. And so, we are finding such opportunities, but the market is still giving us 0.7, 0.8 price to book. You guys will wake up one day, but let me buy first.
We have been buying.
We have about 30 seconds left for both of you. What is the best investment that you've made?
Sorry?
What is the best investment you've ever made?
Oh, raise a nice son.
What can I say that'll beat that? No, I think you have to invest in yourself. I mean, each of us has to invest in yourself. Make sure that you get better every day, and make sure that you become a more valuable asset to the organizations and the stakeholders around you.
Ronnie, Adriel, thank you very much. Let's give them a round of applause.
Please welcome back to the stage our host, Bloomberg's Eric Schatzker.
Folks, I'll just try to keep your attention here for a couple of minutes. By now, you've probably all seen the election results that came out overnight from India. Earlier, I described them as stunning because they are, in fact, stunning, rather than the landslide victory that Narendra Modi predicted, 400 seats or more. His party lost its outright majority, winning only 239 seats, and that has forced him to rely on allied parties to remain Prime Minister of India. And it obviously suggests that he may have to govern very differently to stay in control. Bloomberg News and Bloomberg Television have dozens and dozens of boots on the ground bringing you all the latest developments. Oh, my God, I'm just getting word from my colleague here, Ed, that Haslinda Amin, my colleague who is on the ground, live on the scene in Delhi, and who is going to bring us some of the latest results, is in fact unavailable to us. So I will take this opportunity to say, let's hope we get Haslinda back in a few short minutes. But in the meantime, folks, now is a good time for us to take a break. Some of you have already done that. Please enjoy some refreshments outside, and be sure to be back in your seats no later than 11:05, because otherwise you're going to miss Bonnie Chan. See you at 11:05.
Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. Our program will begin now. Please welcome to the stage Bonnie Chan, CEO at Hong Kong Exchanges and Clearing Limited, for a conversation with Bloomberg's Stephen Engel.
Always good to see you.
Always good to see you. And we'll see you up in China as well soon, too. In Dalian at the World Economic Forum. Hello, everybody. Everybody get something to eat, I hope. Bonnie, you know, it's not to hit you hard right off the bat, but it's been a kind of a tough run for the Chinese economy and Hong Kong stocks. Since you took over in March, though, as CEO, it's up about 11%, the Hang Seng Index. It's all because of you.
It's all because of me.
I'm sure. So obviously, you cannot control the pace of growth in the Chinese economy. You cannot dictate Chinese government policy, and you definitely don't have your finger on the pulse of geopolitics right now. But what is your utmost priority to return confidence to HKEX and the Hong Kong Stock Exchange?
Right. I think actually you described it very well. There are a lot of things that I cannot control, but I can get myself and HKEX ready for the opportunities which are to come. So today, I counted, it's my 97th day as CEO. You know, by Sunday, I'll be celebrating my 100 days as CEO together with my Dragon Boat team in Stanley. But anyways, what I would like to say is this. I think what we are observing is, in fact, a lot of changing orders globally. And that added to the fact, that added to this phenomenon you just mentioned, which is the fact that there are so many things we cannot control. Geopolitically, things are obviously changing a lot. The way, capital is formed these days, and this has a lot to do with what we are observing in the IPO markets, that's also changed significantly in the last few years. Technological innovation in the area that we are most relevant to in the exchange business, that has also significantly changed. And of course, a lot of you are aware that earlier, just a few days ago, the U.S. market has turned to a T+1 settlement, right? So that's one manifestation of this kind of technological enhancements that, exchanges need to continue and continuously work on to match the needs of clients and investors around the world. And last but not the least, financial markets in general, that's a big sort of set of changes as well. So nowadays, as exchange operators, we don't only compete with fellow exchanges, we compete with a very new set of competitors, including big techs, digital natives, etc., right? So as I became CEO, I was sort of thinking to myself, what should I do? What should I focus on? And therefore, one of the first thing I published is a blog. This is probably about 2 months ago. I gave it a title, Redefining Resilience. And I think that is critical for exchange operators, is to make sure that we can really handle all these, or continue our operations amidst all these changes. Right. And as part of that blog, I also announced that we are investing very big into technology. So we are going to embark on a very exciting journey building our own derivative platform. This is called the Orion Derivative Platform. This will be a multiple-year exercise, but that's one example of the kind of things that I'm most focused on. I do think that, the long-term promise is good, and therefore we need to get ourselves ready, yeah?
Yeah, the proximity to China, you've always been talking about that, obviously, and it is an advantage. It's a competitive advantage to China. Sorry to bring you into the Bloomberg terminal, but we're going to bring up the chart. You've seen this chart.
Yes.
You know what I'm talking about. The drop-off in IPOs, basically the smallest combined value last year in a couple of decades, on top of a 68% fall the year before that. So how are you going to get those bars going back up? Obviously, there are different schemes in place. The pipeline, you've said, is about 100 deep. What can you update from about a month ago when we last talked to you?
Sure. So, yes, I'm very familiar with that chart.
Did we bring it up, I hope?
First of all, it's not specific to Hong Kong. I think, globally, the IPO market has been very challenging for the last couple of years. I mentioned earlier, right, capital formation, has changed a lot. Companies stay private for longer. And for a lot of companies, as a result of, geopolitical considerations and other reasons, they may choose to list on the domestic exchanges. That's one phenomenon we have picked up in the last couple of years. anyways, what we are doing, first of all, I think the proposition that we're able to offer is still very compelling. As you know, getting a listing status is in Hong Kong, and this applies to both mainland Chinese companies, Hong Kong-based companies, as well as international companies, give you that unique opportunity to be Stock Connect included, which is unique to Hong Kong. No other exchanges offer that.
And this is the 10th anniversary of the Stock Connect.
And this year is the 10th anniversary of the Stock Connect program. And once you're included in the Connect program, that means southbound and flows. This is mainland investors looking to diversify their investments can therefore invest in the stocks. And I will tell you that recently we are seeing very strong flow, southbound flows, which I think is a reflection of the increased interest of mainland-based investors to diversify their investments. Obviously, Hong Kong is a very convenient place for them to treasure hunt, shall we say. We provide them with this very convenient piece of infrastructure, which is the Stock Connect program. And therefore, I think that long-term promise is there. Now, you asked me what has changed, right, since we last spoke. I think a lot of you will be familiar with some recent announcements from the mainland authorities, and this is in April, so just a couple of months ago.
The CSRC, the Securities Regulator, April 19th.
Yeah, there are two sets. The first set was from the State Council, which is the 9 measures. That was on the 12th of April, followed very shortly by the CSRC on the 19th of April. And the clear message is, from one of the measures in the CSRC set of 5, is that they are going to encourage leading companies in the mainland to come to Hong Kong to seek a listing. Now, if you look at that in conjunction with the State Council 9 measures, I think there is a very clear direction of travel. Because the 9 measures is more aimed towards the Asia market itself, right? They're talking about a lot of reforms to raise quality, etc., which is very good. They would like to also encourage Asia-listed companies to be more frequent in terms of paying dividends to investors, which to me translate into this kind of a division of labor amongst all the exchanges, the 3 domestic ones on the mainland and Hong Kong, which is that I think Hong Kong now have a very special role to play in terms of supporting fundraising needs of the new economy companies, especially the ones which are not yet in a position to pay dividend. For example, if you're still very heavy into R&D, right, that's what you prioritize. And for those companies, I think Hong Kong is becoming an even more attractive venue for them to consider doing their IPOs.
Well, I want to talk about how Hong Kong can take advantage of this push by Xi Jinping and the top leadership into the new 3, into EVs, into batteries, into solar, which has raised the ire, obviously, of Western trading partners and the allegations of overcapacity. So what can Hong Kong Exchange do to help, help the benefits of China's push for the new 3 and have more companies in these areas list, but at the same time, you have to deal with potential blowback from the West and institutional investors and their risk management?
Okay. So first of all, we need to provide them with the framework to list, right? Because at the end of the day, to build or to develop further in those big 3s, you need more companies, right? Better technology, and all that has to be supported by capital, accessibility to capital. So first of all, we already built the listing chapter for it. And that was the most recent addition to our Red Book. That's chapter 18C, which I wrote before I left listing 2 years ago. So with the chapter, right, and this is the chapter catering the needs of what we call specialist technology companies, right? These are pre-revenue companies, heavy into R&D, but they're in areas such as new energy, right, which is what you're alluding to, and it also covers other things like new materials, artificial intelligence, etc.
But there have only been two. Can I play the devil's advocate here? There's only been two under Chapter 18.
Yeah, one is...
Black Sesame is one, and one just got approval. Quantum.
No, they've launched.
They've launched.
Yeah, they've launched, okay? I read in the paper that the first day retail
June 13th, I guess they're going to
retail subscription is already 10 times oversubscribed.
That's Quantum Farm.
Yeah.
It's a biotech company.
It's a biotech company, yeah, but they use AI.
So would you call this a lukewarm response to the specialist technology push, the pre-revenue companies?
Well, I wouldn't say so. I think, first of all, we launched that chapter only a couple of years ago. And well, first of all, once you've launched a chapter, right, it takes time for companies to get the process ready, right? They need to draft the prospectus and all that, and then get the application in. And frankly, right, for companies, which have a good equity story, they're also timing the market. You only IPO once. You want the best valuation for your IPO. So I don't think, it's that. In fact, what we are actually seeing is a lot of interest, especially following those 5 measures from the CSRC. A lot of inquiries have come in from specialist technology as well as biotechnology companies. So I don't think there's an issue at all. But to your earlier question, what are we doing, right, to hopefully get that IPO momentum going or improving? So first of all the listing framework is there, for the specialist technology companies. And secondly, I think at the end of the day, it's about building out that ecosystem. So we have, if you go back to 2018 when we introduced 18A, the biotechnology chapter, I still remember I was in private practice back then. There was no ecosystem, right? We have no research analysts in the space in Hong Kong. We have very few specialist bankers or lawyers who know how to write a biotechnology prospectus in town. But in a short course of a few years, Hong Kong is now the second largest biotechnology fundraising hub in the world. And we have since listed, 60-odd biotechnology companies. And it's, it's a compelling offering that we've successfully built. So I think in terms of the new 3 that you're alluding to, is to get that ecosystem ready. Now, I do believe that the demand is there. You talk about overcapacity, but what we are seeing, and is this phenomena. Now, a lot of you are obviously aware that there are many countries have made pledges to become carbon neutral by 2050 or 2060. How are they going to get there? Okay, you don't just sort of wake up one day and all of a sudden you transition, right? You need to build up to it, and in building up to it, you need the enablers. So you need EVs, you need solar panels, you need wind turbines, and you want to get access to those in an affordable manner, right? So I still remember, and let me tell you a short story. I was in Beijing in March for the China Development Forum, and I attended a fireside chat. This one is between Tim Cook of Apple and a professor from Tsinghua University. And they were talking about green transitioning. That piqued my interest because, I was wondering what Tim Cook had to say. And he was very straightforward. He said that, by 2030, Apple wants to produce all their products, everything, in a carbon neutral manner. And, it's 2024, 6 years, right, from 2030. Right now, they have only the Apple Watch that they managed to produce in a carbon neutral manner. And he went on to say that it's because the supply chain is mostly China. All the components were sourced there. That got me thinking, right, so if that's one company, right, getting on with that green transitioning, multiply that for I don't know how many times, right? This is what all the countries which have made the pledge to be carbon neutral by 2050 or 2060, they have to do the same. So the demand is there, okay? Now, whether or not, people can debate about whether this is overcapacity or not, but I still would rebut by asking the same question. How are these countries going to get there?
Obviously, data security reviews are a big part of approval from the CSRC to list abroad, and Hong Kong is in essence a market that is a separate jurisdiction. So we're going to see more listings, but are we going to get the approval for those sensitive industries in AI, in quantum computing, in semiconductors? I know that we just got CSRC approval for the FedEx of China, SF.
Yes.
That potentially could be upwards of $3 billion. I've seen a number of different numbers, a 1 billion listing or $3 billion US. So are you expecting a sort of a slow tide in or a tidal wave of listings coming?
So first of all, you mentioned the CSRC approval. That's a relatively new introduction. It only started from the end of March last year. So I think it does take a time, for the authorities in the mainland to get used to the rhythm of the mic just. Oh, okay. Yeah.
I was about to give you mine, so that's okay. We're good.
It came back. So it does take time, right, for everyone to get used to the rhythm of going through the filing process. And it's not just the CSRC, okay? In order for a company looking to list offshore, right, whether it's Hong Kong or other markets, they need to also go to the respective industry regulator to get, the green light. And so, I think what we saw last year, and a lot of people say, well, it took very long. It's more a teething issue for me. It seems like that to me. And over time, we have now seen companies in different categories successfully getting the green light. Okay, so I still remember the first batch came out in end of May last year, and was all H-share companies incorporated under PRC law. And everyone got very concerned. Oh, does it mean that red chip companies cannot get green light, right? Then, of course, the second batch, they approve a lot of red chips. Then people ask, oh, does that mean VIEs wouldn't get approval? Then, of course, VIEs got approved. So I think, we just have to, wait for the process to bed down. I'm very...
There's an impatient room here. They want to know Didi. They want to know Aramco. They want to know Ant Financial. They want all the big ones. SF is a good step. That's going to be a big listing. Yeah. But you're cautious.
You know I'm not...
I know you're not going to talk about specific
companies. I'm not
companies.
able to talk about any specific company. But suffice to say that it's good that the room is talking about it, because, that to me means that you want to see these listings in Hong Kong, right? So we will do our part, to continue pitching to them. And I do really believe that Hong Kong is a very compelling listing platform for all these companies.
What's your priorities for your international outreach? Obviously, you had a conference here in Saudi Arabia. There is a Saudi ETF listed here. Could there be a Hong Kong or HSI index ETF in Riyadh? Could there be dual listings? What are you working at right now?
Yeah, I'd love to talk about that. I mean, of course, the Middle East is only one.
We have a minute 25.
Example of our international outreach. We do a lot in Americas and Europe, as well as Southeast Asia. But yes, that CMF conference we hosted a few weeks ago was a smashing success, with 650 people attending the conference. Above 200 of them actually flew in from the Middle East. And what we did was not only the main stage events, we hosted 300 plus bilateral meetings to match-make investors and corporates from both the Middle East as well as Hong Kong, China. And we think that, through these bilateral meetings, hopefully a lot of business opportunities will come out. Whether or not there will be an IPO, we will wait and see. But suffice to say that our cooperation with, especially the Saudi Tadawul Group, started in February last year when we signed the MOU, and we've been actively working on it. So it doesn't stop with an MOU, right? Since then, we've recognized Tadawul as a recognized stock exchange, so that a company listed there can come to Hong Kong for a secondary listing. We have listed the first ETF, Saudi ETF. This is the first in Asia and the biggest globally to date. And then we hosted CMF, which is very successful. And I will tell you that later this year in October, I will be there for the FII.
FII, yep.
Yeah.
We're out of time, but I have to ask you your best investment. I know you've been in the gym this morning already.
Oh, yes.
You wake up at 3:30 or 4 o'clock in the morning, so obviously you're investing in your health.
Yes.
But what's your most important investment, personally?
No, that's exactly my best investment. So, okay.
Oh.
For this job, it does require a lot of energy. So I'm a member of the 5 a.m. club, in fact, 4:45 to be exact. I go to the gym, I lift weights, but it's really great. Getting that energy, right, so that I can go into the office, have a fresh mind, and my job does give me a lot of energy back. On that happy note.
Thank you so much.
Thank you.
I have more questions, though. We'll have to resume the conversation
Dalian.
at the World Economic Forum in Dalian. Tune in at the end of
There we go.
All right, thank you.
Thank you.
To Bonnie Chan.
Thank you.
Please welcome to the stage Vikram Malhotra, co-founder and CEO at 360 One Global, and Nitin Singh, head of Private Bank Asia at Barclays, for a conversation with Bloomberg's K1 Ha.
Stunning election results, which we're going to get into. But first, let me tell you a little bit about India. India is home to nearly $850,000 millionaires, and the number of ultra high net worth individuals in the country are expected to jump 50% by the year 2028. Big numbers. And of course, that's because the Indian economy is booming, and pro-business policies are helping to create these pockets of wealth, as well as widening inequality. Of course, you've got Prime Minister Narendra Modi and his ruling Bharatiya Janata Party. They, of course, have been helping to mint Indian billionaires at such a brisk pace. And, of course, we're also seeing so many Indians being propelled into the ranks of the ultra-wealthy. So fantastic conversation center with these election results. We have to get into it. I was actually in the recording studio until after midnight to record this morning's podcast, which you can now download. But obviously, no one expected these results. I mean, what we're seeing is essentially Modi and the BJP party have lost its majority, and they're now having to reach out to allies, essentially, to really form a government. What do you think that is going to do to investors? How should investors receive this news?
Well, I think they already had picked their allies pre-election. So while results, of course, are quite different from what was expected and, markets reacted in a knee-jerk way, the NDA as a coalition already has a majority beyond what is expected. BJP as a single party does not have that majority. So I think from that perspective, of course, a fair bit of difference. But if you see there would be immediate short-term volatility, etc., next few days till the government is formed, it's widely expected Narendra Modi will form the government as the next prime minister with the NDA alliance. And we should not see too much of a fundamental change in the reforms or the progress that India has been seeing for the last decade or beyond in this century.
To paraphrase Ruchir Sharma, India has an amazing habit of always disappointing both the optimists as well as the pessimists. I'm not that shocked or surprised by what we've seen in terms of the election result. Of course, as Vikram said, it is something that is against what everyone's been talking about. But historically, India has always had a coalition government, right? In fact, it's only over the last 10 years that you've seen a large majority one-time government actually being there as a single-party government. And despite that, you've seen the Indian economy essentially double every 4 to 4.5 years, right?
Yeah. And in fact, I mean, the coalition governments have actually worked. They're pretty effective in terms of getting stuff done.
Yes, exactly. And I think therefore, whatever that you've seen over the last few days, of course, both the euphoria as well as the immediate turn back is, of course, reflective of what people think, a little bit of disappointment, etc. But I think to say 2 or 3 things about India, right? You've seen the macro change in India over the course of the last many years. You've seen the kind of reforms that have happened, both from what we call the JAM Trinity, which is looking at the way the digital populace has changed, look at the kind of work that has happened on infrastructure, look at the kind of work that is happening across CapEx, etc. And I think, just to take on from what Vikram is saying, you will see a little bit maybe on the corners in terms of maybe a little bit of populism, but I think generally the path of fiscal prudence, generally the path of continuing to invest in the economy, and generally the path that you will continue to see growth within India, touchwood so far seems unchanged unless you see a really force majeure event, which I don't think is in any of our minds right now.
Well, it's great to get that assessment from you guys. Now, we saw foreign investors, I mean, yesterday with the stock market drop, I mean, obviously that was just immediate reaction. It dropped to the lowest in 4 years. But generally, foreign investors have poured in nearly $21 billion into Indian equities last year. They pulled back ahead of the elections because of the uncertainty there. What do we expect, you think, now post-election? What do we expect to see with foreign investment?
So, it's interesting. We use this word called foreign investment, but it's actually a bunch of about 500 to 600 different managers, be it either hedge fund managers, long-term holders, etc., who will all think differently. But I do think that there are 2 or 3 things. See, the first one is, of course, the fact that has there been a little bit of dent to the story of saying that there is going to be policy stability, there is going to be continued governance, there is, and this story is only going to go higher and higher and higher. Yes, to some extent, that's changed on the margins. But I think clearly the long-term story hasn't changed at all, actually. Actually, I would say, just paraphrasing from what you're saying, that in times of coalition economics, we've actually seen a lot of decisions being taken that are harder. I think you will continue to see corporate earnings growth happen. You will continue to see CapEx investment happen. You will continue to see, I think one of the good things that will happen now is in terms of trying to help the domestic consumption numbers increase in terms of really focusing on the rural poor as well as on the poor below. And I think on the back of that, my belief is that you will see foreign investments come back, both of course on the fact that you will see more money come into fixed income, because actually a lot of that was waiting on the sidelines for the inclusion that's going to happen. Our fiscal prudence is better because RBI has given a significant amount of money, and therefore we have the liberty to be able to be a little populist whilst at the same time ensuring to have fiscal prudence. And I think all of that is going to be looked at by foreign investors positively. So my belief is that India, which was maybe a little overvalued, you've seen a much needed correction that has happened. And I think a lot of the money that's sitting, you will actually look at seeing come in over the course of the next few months.
Vikram?
I think, global capital is very under invested into India. So if you see India's 3.5% global GDP, but if we go into the allocation that comes India's way, that is far, far less. So the opportunity is humongous. And I think corrections like this or events like these lead to sort of convey more conviction about entering. So conversely, locally, the industry has also been gaining for a lot of wealth coming in. So we have something called a systematic investment plan into the mutual funds, which is now seeing about $2.5 billion come in month on month. And this is very long-term sticky money. In a mutual fund industry, we have only about 15% of GDP into mutual funds. Compare this with some of the more developed economies, it's as high as 70%. So you see the amount of room there is for more flow to come in, domestic as well. So I think from both sides, offshore as well as onshore, things continue to look compelling, and opportunities like this prove to be generally good entry points.
Oh, that's good news, certainly. Now, we've seen big changes in household wealth in India. I know we've got a chart that will show that it's the fastest growing in Asia Pacific. Now,
Vikram, how is that changing the approach for wealth management market? And, in terms of how do you reach out to those individuals who are wealthy or newly wealthy in markets outside of Mumbai and Delhi, outside of the top tier cities?
So I think that's something we as a firm have done very well in terms of capturing new wealth creation that is happening in India. In terms of liquidity events, there are literally 3 a day. Less than the previous year, but still 3 events a day. And I think, trying to reach that money to have that managed professionally, I think is key to our business. I think while traditionally everybody's looked only at the major cities, there is in India much beyond that. So for example, if we see again in the mutual fund industry, the B30, that is beyond 30 cities, beyond the top 30 cities, contribution to the whole number is about 22-23%. This was as low as 14%, I think 5-6 years ago. So we are seeing a lot of money coming in from the so-called smaller towns. So there is a lot of wealth there. It's always been there. It's always been known that it's been there, but I think now it's coming into the capital markets much more than it was in the past.
Finding a way to tap into that.
Yes, I think clearly, India historically was always a nation of savers. I think the interesting thing that has happened over the course of the last few years is that it's become a nation of investors. And you saw this trend happen across 2 or 3 things. The first one, of course, being what Vikram spoke about, which was the systematic investment plans and how investing has become part of the DNA of everyone, actually, and it's great. I think the second thing that you've seen is that there's a rapid financialization of assets that has happened on the ultra-high net worth side as well. So historically, stuff like real estate, stuff like physical property, real assets, which continue to be important, but were always large. You've seen that shift happen. You've seen that equities culture. You've seen money come into fixed income, and you've also seen stuff like private markets, private assets, etc., pick up. And I may be jumping to a later question, but I think coming back, therefore, what you're actually tending to see is that it's the fastest growing domestic wealth market in the world. You're minting millionaires and billionaires every day, and it's not only new money and liquidity events, but it's also old economy, right? So, and therefore the demand for wealth management services and the demand for what we do globally, right? When you look at asset allocation, you look at various types of asset classes, you look at, all of that is now coming to fore in India. So therefore, it's a very exciting place to be as a wealth manager today. And, clients are becoming more sophisticated. They are asking for more. And I think you're going to see that continue to happen secularly over the next few years.
And what about alternative investment strategies, Vikram? How important is that for Indian families?
I think, again, we are massively underpenetrated at 3-4-5%, and this should ideally be a much higher double-digit number. And a lot of wealth creation has happened in this space, which is leading to the liquidity events, as I mentioned earlier. So we are very large in the alternative asset management business. In fact, we've launched our first secondaries fund. It's the first in India and actually very, very well received. So increasingly, Indians have always been astute investors. It's not that they haven't been. It's just that there have been pockets and they've been trying to do it themselves. So I think a formalization of choosing a professional wealth manager or an asset manager to manage the money for you is growing. And within that, I think alternatives is very, very compelling. And all the way from angel investing to pre-IPO, we've seen that space grow massively. AIFs within the mutual fund industry, alternative investment funds as we call it, I think that has seen a 25 to 30% increase in the last few years. So I think leading with alternatives, and people are very, very open to investing into alternatives.
I think it's a very interesting trend. You've seen that whole cycle happen over the last few years. So till about 3 or 4 years ago, we were maybe 3 or 4%. You saw the venture capital cycle start in India on the back of all the unicorns getting created and especially post-COVID. And I like to say that what COVID did to India was that it accelerated the growth of financial savings and it accelerated the growth of the alternate asset class. And over the course of 2 to 3 years, you saw the rapid expansion of what would have typically taken 10 years. And it not only happened in venture cap, but it's happened across the piece. So venture capital, private equity, late-stage growth investing, secondaries, private credit, which has become a very large opportunity, right? And actually over there, so you're seeing entrepreneurial managers come up. You're seeing managers becoming larger and larger. Just to quote an example, and without taking the name, when I talked to some Indian Indian asset managers, historically, most of the money they used to raise used to be internationally for private credit or structured credit or distressed assets, etc. And today they're saying that about 50% of the money that they're raising for a new fund is coming from domestic flows of individuals. Now that's where players like us play a role, who've been there for the last 16 years and who've got a very strong piece built across not only being able to identify interesting managers, but also be able to support clients through this journey of being able to select them and then work with them across the other needs that they have, right? Because clients are becoming very sophisticated. They're doing single assets, they're getting into funds, right? They want to be able to take strategic opportunities in companies. So it's as exciting as what I was hearing Bonnie talk about earlier or anywhere else, right? That market's fully exploding.
And they're also looking, I imagine, for offshore opportunities as well, cross-border opportunities, right?
Yes, in a big way, actually. I think historically everybody talks about the fact that India is a closed capital account country and therefore you're only allowed to send a certain amount of money every year, which we call LRS, which is the liberalized remittance scheme, and therefore you typically can send up to $250,000. Now that number's of course gone up dramatically. But I think generally, and with specific reference to ultra HNIs, they're becoming more globally mobile, both with regard to their businesses as well as with regard to their own personal needs. They want to look at their portfolios and they want to have offshore exposure in exactly the same way. Not like the times of old when people wanted to send money out for the sake of sending money out, but just the fact that they want to have an international portfolio like anyone else, right? And therefore, which is where players like us, etc., come in, where you have that connectivity across markets and where you can provide a full platform. Because the Indians are spoiled for choice and for service. Typically for most Asian clients and for Indian clients, right, the service that they receive from wealth managers, be it in this room or otherwise, is normally a level higher. And they expect that same service when they go out.
Yeah.
And which is where they look for full platforms like us who can actually then connect us across the ecosystems.
Yeah. Vikram, I wanted to ask you, I mean, we are in India seeing, in many ways, the first generation of wealth emerge for many Indian families there. How important is the themes of succession and wealth transfer?
I think as important as anywhere else, but obviously, as you rightly said, there's a lot of wealth still being created in first generational wealth. However, working with these clients earlier on helps in terms of, we've seen in the past, maybe a decade ago, very well known sort of families where the successors literally fought for the pie subsequently because it wasn't well sort of structured or planned. Increasingly now, I think whether it is the spouse who's succeeding or the children, I think these conversations are happening. All of us actually are full-fledged setups where we wealth advisory, succession planning, estate planning is an integral part of our offering, and I think clients are very open and keen on continued conversations as their sort of family situations and sort of business interests evolve both locally and, like Nitin said, offshore as well.
And for most families, as you talk about succession, is it very much trying to keep it into the family? Obviously, these family conglomerates are very popular.
No, I think just taking on from what Vikram said, it's no longer a taboo word. It's no longer a piece about the fact that the patriarch doesn't want to give up control. It's much more thought through. It's much more well structured. Older conglomerates have gone through generations now of doing that, and they've learned their lessons. The newer guys, as Vikram was saying, online towards liquidity events ensure that they're able to do all of it. I think generally there's always been this piece about, of course, taxation and uniform civil code and various other things, but generally all of these are now being created with longer term thought processes in mind. Not only trust and succession planning, but also thinking through family councils, how do you avoid conflicts? All of that is now front and center. And I think that's extremely healthy actually. Because people are really thinking about this in a holistic manner, which wasn't necessarily the case till a few years ago. And interestingly, you've got the two players in the room who actually run full-fledged setups in this. And these are key areas of strength for us in terms of really being able to reach out to clients and provide them these services.
Now, of course, there is a huge wealth gap in India, right? It's great that there are so many billionaires and millionaires popping up, but the top 10% of the Indian population do control about 80% of the country's wealth there. How sustainable is this?
I think this is something where we need to see the benefit or growth in the economy percolating down, and therefore now, again, results in a manner speak to this direction, and there will be some, I think it was already happening, but it just happened step by step. So I think there'll be a bit of acceleration there, because we can't have such a wide gap, as you rightly point out, and the sort of benefit of prosperity and growth should percolate down all the way to the rural and deeper parts of India. So I think everybody realizes that. Steps have been taken first to fix the top, as then the benefit can percolate to the bottom. But it's a very fair point and needs to be addressed. But I'm confident it will be addressed and is being addressed, especially in this in the next government that will be formed.
Because I mean that's certainly something that I think has resonated in this election cycle, right? The inequality, right? I mean, how long can you really have that?
Well, talking about, and data can be seen anyway, but this 10%, 60% is actually common across a lot of countries, right? But I think the great thing about India is the plurality of its democracy and of this message coming out very clearly. I think irrespective of what happened in the elections, it was very clear that job creation was going to be a very important focus going forward. The fact that you were seeing, whilst you had seen premiumization of consumer brands and that increased, but you hadn't seen that same thing happen with mass market consumer brands, reflected the fact that there was a little bit of issue in terms of that post-COVID things hadn't picked up to that same level for that last mass. And I think there will be a lot of focus of this government in terms of trying to help that. And historically, that's always been the case, right? You look at a lot of the schemes that have happened. It's always been a mixture of fiscal prudence, welfare towards what you do, and then trying to create this job opportunity. And I think the whole growth of, outside of agriculture, the biggest consumer of jobs in India is construction. Right? I mean, that's a given, and that's especially for the rural economies, etc. Now, you need to increase this. You need to continue focusing on infrastructure. You need to continue focusing on capital formation, because that will then automatically lead to this getting elevated properly. So I think the blue-collar worker and being able to address this piece is going to be something that's going to be key to the government going forward.
And what about, since we're on elections, I mean, the next 100 days are obviously important. And I was talking to, on the podcast, I mean, one of our experts there was saying, actually, the next 100 hours is really important, right? What does Modi, assuming that he can get together this coalition government, what should he be focusing on in the next 100 days, especially as we look to bringing in more foreign investment?
I think, the interesting thing about India is that there's always an election around the corner. Right, we've just finished with this mother fall elections, and now you'll have state elections, and then so you go from one election to the other. Yeah. So I think we are reading a lot into it. It's my view. I do think that generally in the next 100 days, as is post any such piece, I think a big piece to look forward to. Is the fact as to what are the policies and what are the changes that could happen on the margin. I think the July budget is a very key event to watch. I think the fact that we've been able to, and therefore, I don't think capital formation, I think focus on privatization, I think continuing to invest in infrastructure, continuing to invest in what you're doing from digital, etc., will stay, irrespective of who it is. I think what has to be seen is how does populism and fiscal prudence get managed to some extent. I do also think that a lot of the larger reforms that would have typically happened will slow down a little. But that's actually the nature of India. Even a lot of stuff, despite the fact that you had 10 years of one-party governance, you haven't really pushed through. So in India, typically it happens step by step. But I think generally we're in the right direction, and I'm lesser worried about how the next 100 hours and 100 days looks. I think unless there's really a force majeure event which we haven't thought through, I think all of our view is the fact that you're in a unidirectional way currently.
Absolutely. I completely agree with Nitin. I think the macro speaks for itself. And, from being called the part of the Fragile Five a decade ago, we've come a long way. So a lot of time, investment, energy has happened in terms of, perception of India outside of India. So I think, and that is bearing fruit. But there's lots more to be done. And, just if you pick any number in India, it just speaks volumes about the potential of the country. So I think any astute investor will see that playing out. And I frankly, again, unless there's something we haven't thought of, capital will continue to come in, but India is very well supported domestically as well, a point I made earlier, which also is a much larger constituent than it was previously. So both sides, I think, play a big role.
Great points. I want to delve a little bit deeper, pick your brain a bit. What advice do you have for my kids and for those young people out there who are trying to build wealth?
Yeah, I think 2 or 3 things. One is start early. A huge proponent of starting early, and it's not easy to do that. Second is that I think our kids look at investing or financial products in a very different manner than we do. Right? I see it with my son who's 12 years old, and I think we live in different ages. And I do think a lot of the fads that are happening today, and time will prove, but I think you need to keep it a little simple. And that is one of my advice always, because they're looking at investing in various fads as well. And you're seeing that, by the way, happen in India as well, digital investing and various other aspects of it. I'm not in the shape to comment, but I think keep it simple today, and stay the course. Stay the course. I think these are the only 3 things that I can say.
Vikram?
Beyond what Nitin said, I think the power of compounding is very powerful. So stay invested. And very importantly, seek advice, delegate.
Yes.
Very, very, very sage. What is the best investment you've ever made, money or otherwise?
I think, Bonnie spoke about it earlier, but I made this investment quite late, and it was only about 2 years ago that I really made this investment on myself in terms of focusing on health. And I think that plays a very big role, and I would say that's one of my best investments so far.
You can't pay for that.
Yeah, you can't pay for that, and I think you typically tend to learn through various cycles because you feel invincible for the first 15, 20 years. But I think that's the single most important investment that I would say that I've made.
Great.
I think for me, it doesn't seem so, but I'm a very active sportsman. I play a lot of squash, and I think sports is something that I'm very passionate about, and it's taught me many things that have worked well for me in my career in terms of teamwork, in terms of never giving up, in terms of losing and coming back, and taking a winning with a lot of humility. So I think sport for me has been my biggest personal investment.
That's great. Vikram, Nitin, thank you so much for your insights and time.
Thank you.
Thank you.
Happy.
Thank you.
Please welcome to the stage Ali Jamal, founder and chairman at Azura Partners, Pierre-Yves Lombard, representative director and head of private banking Japan at Lombard Odier Group, and Rajesh Manwani, head of markets and wealth management solutions Asia at Julius Baer, for a conversation with Bloomberg's Denise Wee.
Thank you so much for joining us. I know all of you have flown over from elsewhere, so welcome to Hong Kong. It's not usually this rainy. And I know we've got about half an hour and 3 panelists, so I'm just going to jump into it because we're everything standing between the audience and lunch. I think the first question on my end is, China has been a real engine of growth for ultras. This is a key target market for private banks. And, it's been a bit slower these days with the IPO engine sort of slowing down, with growth slowing down. So what are the key engines of growth for the new ultras? Rajesh, if you could start.
Sure. Thank you for calling us. It's a great panel. It's been a great session so far. Indeed, China has been huge. It's been massive. For most wealth managers, it's the single largest market. And I dare say it will continue to be the single largest market. The size is just absolutely huge. You have $2.5 million millionaires. You have 55,000 ultra-high net worth clients. It's a factor of 2 to 5 compared to the next and the one after that. So it's absolutely huge for us, and I think for the rest of the industry, it will continue to be huge as well. Growth has slightly slowed down, but it doesn't mean the industry is not growing. Whereas in terms of where the growth we see is Japan and India. India, you've seen 3 years of excellent growth, and when you think about how ultra-high net worth wealth is created, IPOs is one, growth in earnings and dividend payouts is the other, and third, growth in asset valuation, typically equities and real estate is the third one. So in terms of percentage growth, I would say India and Japan way above, but in terms of just absolute magnitude, still a few years to catch up with China.
Okay, so it's still India and Japan. Pierre, I know you're based in Japan, so I wondered what your opinion was.
I think similar to what Rajesh had said, beyond looking at India and China in terms of the size of the markets, I think Japan at the moment is really growing. The local markets have been very successful, both on the liquid side and the illiquid side. That's created quite a lot of demand for IPOs and businesses being bought by private equity or larger businesses. I think all that wealth created is definitely leading the third largest ultra-high market to grow. So we also see a lot of growth onshore on the Japan side. And we see a lot of demand from those families for international wealth management services. So beyond just looking at domestic wealth management services. Obviously, we've been onshore for 4 decades, so quite a long time. And we think Japan is a very interesting market. We signed an alliance with the Mizuho Group to tap their onshore know-how and mix it up with our international expertise. And we think that will be a very good source of growth for us in the region.
And Ali, I just wondered what your view is. You're obviously traveling a lot. You're not based in you're based in one place, but you're traveling all the time. So where do you see the biggest growth right now?
I think the emerging market across Latin America is growing so fast with the ultra-high net worth. Asia has been the discussion of everybody. Everybody liked the China story, the Hong Kong story, Singapore becoming a big winner. India, you cannot discount it. And also what's happening in the Middle East, creating more opportunity for newcomers. There is stability in the region from political point of view. There is a new wealth has been creating, leading by Saudi Arabia with all the revolution what we see in Saudi Arabia domestically. There is a lot of wealth will be created. We see more Latin America, India, and Asia has been always there. And I think the Middle East is a new hub, a new market to be focused at.
Okay, that's interesting. Yeah, definitely a lot of Middle East. It's a growing region, a lot of attention on Middle East. And talking about Middle East, I just wanted to talk a bit about geopolitics in general. Clearly we've seen a lot of China-U.S. tensions. Positions have hardened. This year is an elections year in the U.S. Geopolitics always sort of ranks quite high among concerns among the ultra-wealthy. So, Pierre, you come from the founding family, Lombard family. I wanted to get a sense from you on what sort of concerns ultras have around geopolitics and also how they're sort of managing that risk.
Thank you for the question, Denise. I think it's one of the most hot topics of the moment. Geopolitics are definitely a big concern for ultras, not just in Asia, but across the world. I think the conflict in Europe, the conflict in the Middle East, and the superpower tensions are definitely leading to clients being concerned. That concern is leading clients to look for the safest and strongest financial centers, but also the safest and strongest financial institutions. As you just mentioned, we've been doing wealth management for 8 generations as a business. This experience is obviously something, and this stability and this continuity is obviously something that clients are increasingly looking for at the moment. And this is obviously a call that we are answering.
So where do you see the safest? You mentioned that you want to go to the safest financial centers, safest banks. Where do you see that?
At the moment, we're seeing from Asia the most demand from Switzerland, Singapore, and as Ali was mentioning, to the UAE.
Okay, so those are the regions that people, like the ultras, feel are safest.
As offshore financial centers, yeah.
Okay, and in terms of banks, do you have a view on the safest banks?
I think people are looking for the banks that are not listed, especially after the recent tensions in the banking market. They're looking for unlisted banks. They're looking for very high capital ratios, the highest credit ratings, and in some cases they're looking for pure play players to diversify their pool of banks.
Okay. And Ali, I just wondered, what's your view in terms of, how you obviously talk to ultras all the time, so how are they sort of hedging themselves?
Look, they look at it differently, like volatility creates opportunity. The regional and the Middle East have the stability which attract more money to it. We see the boom in Dubai, we see the boom in Abu Dhabi from family office. Either it's an American, it's an Asian, it's an RI, it's even European family moving down there. I think the lack of vision Europe having today where the Middle East focus, look, we want to grow the business. This is the priority for us. We don't want to take a side of any war, anything in the world. We have a domestic priority. We want to focus at it. And this is making it a big difference to attract foreign money to the region, number one. And number two, I think big family offices also moving down there for the regulatory reason. What Dubai, and Abu Dhabi has been done recently, and the political stability in the Gulf state.
Okay, so basically a lot of stability in the Middle East you see
100%.
at the moment. Okay.
Denise, maybe if I may just add to that. We have an annual survey, being very close to our family office clients. We have a survey called the Family Barometer. And for the first time last year, the single biggest factor for families from an investment standpoint was geographical asset diversification. And the single biggest factor for the non-investment aspects was making sure that my wealth structure is in good shape. And some of the drivers behind that was the very conscious sort of knowledge of the fact that geopolitics is changing at a rapid pace and what that means for these families. So it's certainly a very important topic for families at this point.
Okay. I'd like to talk a bit more about, competition for ultras is ultra keen, ultra competitive. And we have various hubs, competing for this money, whether it's Hong Kong here, or Singapore, or Dubai, or London, or the US. Like, where do you think the money is going? Like, who's winning at the moment? Rajesh, if you could address that.
So actually, we speak about this, but if you go back, financial centers have learned from each other, competed in a healthy manner for forever. Whether it was asset management, whether it was capital markets, whether it is listings on exchanges, whether it's hedge fund assets being domiciled. So this is not new, in my opinion. Every financial center will have its own value proposition, will have its strengths that it will play to, and eventually it's not a binary game for families. They will choose not just one, but potentially two or three that best fit the triangle of themselves and their families. And there's a lot of next generation wealth next generation actually looking to re-domicile themselves because of education or whatever reasons. Second, I think has a great role to play. And we are seeing that that's the great point to access China. There is no substitute if you want to access China. All the Connect schemes, including the Wealth Management Connect, are great ways to access China. So Hong Kong is playing to its strengths of a 30, 40-year history. We have relationship managers who have done just wealth management for 35 years. We have wealth planners in Hong Kong who've just done wealth planning for 30 years. And that kind of
Pierre-Yves, we seem to have some tech problems. Pierre-Yves, I'd just like to get your opinion on, in terms of, where the money flow is going.
I think in terms of offshore wealth hubs, Switzerland, Hong Kong, and Singapore remain the three largest hubs, if you look at the latest data from the Boston Consulting Group. But in terms of growth, and I think that's where it's interesting, the UAE, as Ali was mentioning, is doing really, really well. And we're seeing Singapore and Hong Kong growth continue. And I think Switzerland will remain quite stable, but quite lower in terms of growth factors going forward. So I think, as Rajesh was saying, Hong Kong will remain a very important hub in terms of its connection with China. And I think China being the biggest market in the region, it will continue to do well from that perspective in terms of growth going forward. The Boston Consulting Group definitely thinks that UAE, Hong Kong, and Singapore will be the three fastest growing hubs for offshore wealth management.
And I mean, the government has been making a lot of effort to bring back family offices. Do you see interest on that end?
Definitely. I think in the region, family offices are mostly choosing Hong Kong and Singapore as their hubs. Moving away from the region, they're choosing mostly the UAE and Switzerland as their hubs. So I definitely think that trend will continue, and those four hubs will continue to strengthen.
Ali, what's your view on this?
I think one place has been missed. It's Miami, to be honest with you. It attracts a lot of Latin American money today. If we look at Hong Kong, which is attracting all the China money, Miami did a fantastic job in the last 4 or 5 years, I think, attracting Latin American money, even as couples of people moving from New York, San Francisco to Miami. 1, 2, I think Hong Kong will come back. Like, it's still the glamour, it's so beautiful, it is buzzing, you feel the wealth in the city, which is amazing, which is super nice. You enjoy it being here. I've been coming here often pre-COVID. I like the city, and I think one day we'll have an office here. Because you have wealth, you have more than 1,000 billionaires in China only. You have lots of talent here, which is very difficult to find it also anywhere in the world. Regulatory framework is good today, okay? I think sooner or later you'll see Hong Kong will stand back and people will come back again.
So you're planning to have an office here, you said?
Hopefully.
Okay. When do you plan to open this?
The minute we find the talent.
Sorry?
The minute we find the talent.
Lots of talent in Hong Kong, lots of talent in this room as well.
I know.
And also the family offices, what's your view? Because Hong Kong has been rolling out the red carpet. Do you see a lot more of the outers trying to open up family offices here?
I think what we see from our point of view, which is my level learning what's happening in China and Hong Kong, is I call it 40,000 feet. There is a lot of money coming from China domestic to Hong Kong. Okay. It's the language, it's understanding the legal framework, understand the local politics is good. To attract foreign money is not going to be easy at this stage. Like a Middle Eastern to open an office in Hong Kong.
Why not? Why isn't?
I think one, it is time zone. Okay, this is one thing. Second, it is still is unknown. Like everybody talking, the Asians want to invest in the Middle East, but we did not see, we see G to G, but we don't see principal to principal yet because of the lack of relationship, and this market has not been developed. Plus, what Switzerland has been doing, what the US has been doing, what London has been doing for the last 2 or 3 decades, attracting all these people. I think sooner or later, we will see people coming back here.
Okay, and Rajesh, do you have any thoughts on the family office front? You know, you're based in Singapore. There's been a lot of family offices there. Do you see momentum in Hong Kong?
There's tremendous momentum in Hong Kong. Just generally, Hong Kong as a location for us, it's the 3rd largest location globally. We have over 500 people here, and we only do private banking. So we are a focused private banking business. So we have 500 people. Last year, we moved into our 100,000 square feet premises in Two Taikoo Place. And that's a reflection of the fact that we strongly believe in Hong Kong, and it's even doing well. Both our locations have had net new money this year, as for the last few years. So they're both doing well. And the recent announcements made since last year around the CIES, around the 7 or 8 factors that go into makes it even more interesting, in addition to the DNA that I mentioned. So it is a very, very competitive location for family offices.
You mentioned that both locations, Hong Kong and Singapore, are doing very well at the moment. So like Singapore has had some issues recently in relation to money laundering. Do you see like the momentum shifting in terms of, you know, where the pendulum swings?
I don't think so. I mean, there were those incidents, but it's like cybersecurity or any of those elements. No matter how much you do, and Singapore in the Southeast Asian context has seemed to be a sterling location in terms of some of those measures in place to make sure it doesn't happen, and yet it can happen. So that's just a reminder. that we all as a financial ecosystem need to keep working hard to learning from these experiences and keep making things better. I don't think the pendulum is swinging. Every location is dealing on its own strengths. Singapore has great access to Southeast Asia. There's a big India corridor in terms of connectivity. It has focused a lot on a more formal approach toward family offices, and those are its strengths. I'm sure Ali will talk about Dubai, which has its huge strengths in terms of access to the Middle East and also playing into the India corridor. But as I mentioned, the Hong Kong strengths have been 30 years of a DNA, great capital markets, exclusive access almost to the Chinese capital markets, massive amount of access to by far the largest wealth pool. So they will all play to their strengths.
Okay, well, we've heard from the panelists about family offices, but I'd like to hear from the audience. So if you could go to our poll, if you could get that up and running. So yeah, the poll question is, what's the best location for family office? We have A, Dubai, B, Geneva, C, Hong Kong, D, New York, and E, Singapore. So there's a QR code for you to scan, in the meantime. So it'd be good to find out, which family office location everybody's looking for. For the moment, while everybody's voting at the moment, if we could look at also maybe investments and where people are putting their money. Rajesh, I'm wondering, where do ultras put most of their money?
So as you can imagine, ultra high net worth is between 30 to 60% of most wealth managers' asset base. So that's a very big pool of assets, and it's not all doing the same things.
Mm-hmm.
I would say there are 3 to 4 major trends or themes which are playing out on different time scales. The most urgent thing is around the impact of interest rates on what investors are doing in their portfolios. So first, there was a trend from sort of like current accounts to deposits. There was a massive sort of deposit war. And now that money is slowly but surely being deployed into fixed income of all sorts, from like the midterm bond equivalents all the way through structured credit in different phases. That's like the most immediate trend on investments. And the flip side is, what do you do with the liability side of the coin? Because your dollar loans have become very, very expensive. So people have reduced the liabilities in dollars, and there is some diversification in terms of liabilities from lower interest rate currencies, perhaps the Swiss franc, perhaps even CNH, to kind of diversify your financing pool on the liability side. The next thing which is going on, which is much more on the longer time scale, and that's what makes me super excited, both about wealth management but also about our role, is there's a massive amount of institutionalization in the way families are approaching the business of investing. The purpose behind it, a proper strategic asset allocation. 10 years back, when I would ask a family, what is your IPS, your investment policy statement, I would get a lot of blank stares. And now that conversation is real. People are looking for outsourced CIO services. People are engaging with custom private markets. So a lot of the stuff that we have depth in has now agency, has now traction. So that's maybe at a much more kind of longer scale. And the intermediate one is US primacy. There's a lot of diversification that has taken place from home bias to the US, led by tech, led by the general access to the market. So those would be, from my perspective, the 3 things that I would say.
And Pierre, what's your thoughts on where ultras put their money?
I think Rajesh made some very good points, but to add to those points, we do a study every year of about 400 to 500 family offices and high net worth individuals. And from the study we did last year, the 2 biggest trends in investing that came out were really around sustainable investing and around private assets. I think there is growing demand and growing interest in both of these areas. Zooming into private assets, there's about 2/3 of the clients that we polled who are interested to invest in private assets, but only about 1/3 who are actually invested in them. So we think there's a lot of demand that's coming for private assets and a lot of education that needs to be done around private assets and including them in our portfolios.
And what about art? I know we sort of chatted about that earlier. Like, what about,
I think rare collectibles, alternative assets, gold, all these kind of asset classes remain interesting to family offices, and all the family offices we speak to have those assets in their portfolios. I think this trend will continue, definitely.
And any particular artists that ultra gravitate to?
I think in the rare collectible space, clients are quite interested in watches, wine, art in general. I think this trend will definitely continue. More recently, because of the geopolitical tensions, gold is also more and more discussions with clients.
And Ali?
I think they covered everything.
I thought you said something about cigars earlier.
Yeah, I was. I was making a joke. I said one of the best performing assets we saw one of our client portfolio for the last 5 years was his cigar collection, to be honest with you.
Okay, I think we've got the results in. So can we have that up on so the result of the poll, basically, surprise, surprise, Hong Kong is top with 48%, and next is Singapore with 28%, and Geneva with 12%, and Dubai with 8%, and New York with 4%.
Clearly no home bias.
No home bias. It wasn't rigged. So, and also, I think I just wanted to check in with you, Rajesh. Earlier, you talked about, alternatives, I think, and just generally how the wealthy are sort of putting money into alternatives. Do you think there are challenges around selling like illiquid structures to ultra-wealthy individuals?
So there's a lot going on in the alternative space. I think you mentioned a bit here. Even when it comes to private markets, there's private equity, there's private credit, there's infrastructure, there's real estate, professionally managed real estate. Even when it comes to private equity, there is the way you go it alone, which is you try to be on the cap table of a company buying your own unlisted investment. You do it through funds, you co-invest, you do it through fund of funds, and so on and so forth. One very interesting dynamic I have seen is when you would talk to family offices, the sort of in-between size family offices, not the nouveau, but not the biggest, there was always this fascination for being on the cap table. I don't want to go through a commingled fund. I want to be on the cap table. And what this recent shakeout has illustrated, that even if you have 3-4 people in the family office looking at direct investments, it's not enough. Because the distribution of outcomes is so skewed, the kind of due diligence that needs to go in is so skewed. So we are seeing a return of the commingled structure back for the sort of in-between size family offices, whereas the really large ones, the one with 7, 8, 10, 12 investment professionals who come from a lot of the private equity due diligence background, they continue to want to participate directly in investments. Fundraising for private markets, illiquid, has been much harder this year. There is also a fear that 60% of private markets tend to be buyouts, and hence, with an increased interest rate environment, does the L in the LBO still work? Because now the cost of the financing the transaction is that much higher. So it has been a tad harder, which has beautifully then been supplied by the semi-liquids that the asset management industry has created, which is trying and creating quarterly liquidity or monthly liquidity from some of these illiquid strategies. So there's a massive interplay of factors going on, primarily driven by the increased interest rates, but also the need to diversify.
I'd like to go into some of the lighter questions. I don't think these questions were very hard, but the first question is, what is the best investment you've made, money or otherwise? I'd like Ali to answer that question.
Money-wise, the best investment, which could be rare for everybody, we invested in a business aviation called VistaJet, and we made like a decent return for our clients. We benefit out of COVID years. I think this was one of our first investment we did. Second, investing in myself and the team, where we are today. I can be proud of my team, what we invested the time and energy. Within 4 years, we operate in 7 countries. 6 countries, 7, New York, Miami, Geneva, Dubai, Singapore, Monaco. We've been growing more than from 0 to 5 billion in the last 4 years. With COVID, with 2 wars, we're 60 professional, and this will never happen without investing a lot of time and energy in working with the team globally.
Okay, and Pierre-Yves?
I think looking with hindsight, as Amy was saying earlier from UBS, I think alternatives have done really well. Technology has done really well. Going forward, we're most excited about sustainable investing. I think sustainable investing and sustainability in general will be one of the biggest drivers of returns going forward. I think it's a 5 trillion a year opportunity in terms of investments. And many investors and family offices are more and more interested in this area and looking for science-based approach on how to invest in that space.
Okay. And what about Patek Philippe watches? What's your view on that?
Definitely. I think rare collectibles in the alternative space will remain an attractive niche. It's a very niche asset class, but I think it will remain attractive for clients, definitely.
Rajesh?
Personally or?
Yeah, personally, yes.
Well, I started my educational career being an electrical engineer. And here I am on the stage with you talking about ultra-high net worth clients. So I am with the consensus panelists before us that investing in myself has been, frankly, the biggest personal success of investments. When I was doing my engineering, I realized I should become, I got interested in business. When I was doing business, I got interested in investments. When I did investments, I got interested in alternative investments. So that for me personally. But in terms of financial investments, two things. In terms of just percentage, it was my small Bitcoin holdings in my MetaMask wallet that played out well, but it didn't make me rich. The thing that actually
So you're going to retire soon?
No, actually it's very small. It was just an experimental purchase, impulse purchase. But the thing, when I moved to Singapore from India, and this was the year 2004, I started putting money in what was then a recently launched iShares ETF called the S&P Core ETF. And that became like my retirement account. Whenever I had some spare cash, I put that. My original investment is now 5x. So in terms of risk-adjusted returns, that's been the most fantastic.
Wow,
so sometimes the simple things work.
Okay. And the next question is, Ali, what's your advice for young people on how to build wealth?
I think focus, discipline, allocate your time for what you like and what you love.
That's it.
That's very simple. Discipline, discipline, discipline. Focus, focus, focus. And allocate your time for something you love.
Okay. And Pierre-Yves?
I think adding to what Ali just said, time, I think, is probably one of the most important factors. What do I mean by time? Compounding, right? So I think the young generations need to start investing as early as possible. Not wait for it to be in their 40s or in their 50s, but really start investing in their 20s. Diversification, compounding, and time are your best friends.
That's true. That's something they never teach you at school.
Definitely.
I have 2 teenage daughters, and I tell them what I said before. It's human capital before financial capital. So once you have the human capital, then you have to worry about the financial capital. The other thing, they're still too young for this, but I strongly believe that markets are generally fairly priced 80 to 90% of the times. So the 10 to 20% of the times you're taking a contrarian view, you better know why you're taking that contrarian view, and you better back it up, and only then it'll pay out. And then the rest, I agree with Pierre-Yves about compounding, diversification, etc. A lot of people talk about this. It's really hard to practice. It's like waking up at 5 a.m. and going to the gym, like Bonnie mentioned. It's hard. You get easily seduced by different things. You believe you know better than the market, and that usually doesn't happen. So it's important to test your assumptions and question everything.
Okay, I think we'll take maybe a question from the audience. One question is, what is the panel's view on family office appetite for crypto-type assets, and the change from traditional assets?
Okay. We always tell our clients that if you invest in art, wine, all this collectible watches, jewelries as an asset class, you should put 1-2% in crypto. If you never done these type of assets, okay, and it was not part of your asset or part of your portfolio, you should not touch this, because too volatile. It's a long term. It is you allocate 1-2% to the whole portfolio. It's not going to change your life.
Okay.
I think similar to what Ali was saying, I think many of our clients are interested in that space. We are not involved in that space directly, but we do see clients invest a small part of their assets in that space.
We have, as Julius Baer, been quite involved in the space because we know that clients will do it one way or the other. So we felt that it's important to get engaged. So for the last 4 years or so, we've been tracking the space. We have been writing research reports for the last 2-3 years. It's very hard with that volatility to have a view on target prices and things like that. But we have been engaged in the space. We also have an investment in SEBA, which is the first of 2 crypto banks in the world. So we've been engaged in the space. what we see happening is originally the hype was driven more by speculation and a little bit trying to make a quick buck, or for these extremely negative views about the collapse of the financial system and how this is all, the traditional financial system is just all a big scam. So that has been replaced by a lot more institutional grade sort of research into the topic. And when we talk to our families' offices these days, there is a big risk that the way the US dollar was used almost as a, like the financialization of the the weaponization of the financial system with sanctions and things like that, from the perspective of family offices, is one reason, whether it's physical gold or whether it's the digital version of that, which is Bitcoin in particular. I'm not talking about the other digital virtual assets, but specifically Bitcoin, which has somewhat similar analogous characteristics, are becoming more and more, maybe 2, 3, 5% kind of allocations of family offices.
Okay. So I think we need to wrap up quite soon. We do have one question, maybe Ali can take. What's the impact of MENA stability of the recent regional conflict and the recent financial challenges in Saudi Arabia?
I'll start quickly with Saudi Arabia, then go to the conflict. I said Saudi Arabia, we see in the media they went to borrow a lot, but it's a country still debt to GDP is one of the lowest in the G20. The country did not invest in infrastructure for the last 50, 70 years. The development recently led by His Excellency MBS to develop the country, to try to be one of the top 10 cities in the world, need this massive investment. He can do it. They've been doing it. And compare them, which is mark-to-market, debt to GDP, still they are the lowest with the G20. I think there's a lot of form about the way they're spending, the new project, but people was laughing at Dubai 20 years ago when they did the Palms. The most expensive real estate has been sold in the Middle East was in the Palms. This is fact. And on the other question, the stability in the Middle East, I think you have to split the Middle East to two. You have the Gulf state, which is Kuwait, Qatar, UAE, Saudi Arabia and Bahrain, and the rest of the Middle East, which is Iran, the Levant, Syria, Jordan, Palestine, and all the way to Israel and up to Turkey. The GCC stake has been holding the stick from the middle, not taking side. They try to do their best between Qataris and Saudi Arabia, even the UAE, in the conflict on the ground. I think there is a big effort, but cannot be done by only the Middle Eastern side. Our European colleagues have to move. Our American colleagues have to move to make it a lot more stable.
Okay, I think that wraps up our panel. Thank you very much. And next up is lunch.
Thank you.
So lunch will be served in the foyer. If you're joining the HSBC roundtable, please head up to the Chatham room on the 7th floor. And also, we'll have more exciting panels this afternoon. So we'll see you back here at 1:40 p.m.
Thank you.
Thank you.
Thank you.